technical services, it reads as any person not being an individual or a Hindu undivided family who is responsible for paying to a resident any sum by way of fees for professional services or fees for technical services. So the issue which I would basically want to focus here is on between these two limbs itself. Fees for professional services and fees for technical services. So coming to the point, the term technical, what is the distinction between technical consultant? Distinction that we need to draw between technical consultancy and technical services. The reason being, the rate of TDS prescribed for technical services is 2%, while technical consultancy comes under the limb of definition of what is professional services. So when you go to the explanation, so technical consultancy is listed under the professional services meaning. 194J, explanation A of 194J defines what is professional services. So professional services means services rendered by a person during the course of carrying on legal, medical, engineering or profession of accountancy or technical consultancy or interior decoration. So it becomes very crucial for us to understand clearly what is the distinction between technical consultancy and fees for technical services. So technical consultancy comes under professional services. Fees for technical services, as Kota sir was mentioning, it's under section 9 subsection 1 explanation 7. Explanation 2 clause 7 is speaking about fees for technical services. So there, fees for technical services means any consideration including lump sum consideration for rendering any managerial, technical or consultancy services, including the provision of service of technical other than technical or other personnel. So this is what fees for technical services reads as. Now when you see this, again when you go back to 194J, it says that TDS on fees for professional services is 10. But TDS on fees for technical services not being professional services. They are also saying it should not be in the nature of professional services. Then it is 2%. So how do you basically understand the relevance of technical service when is this technical service not coming under the scope of professional service? How do you basically understand that becomes crucial. See, when you see the history earlier, many of these judicial precedents, assessee was always treating some particular transactions as coming under the scope of a definition of work under 194C. So when 194C was triggering, the rate of tax was 2%. So assessee was always tempted to deduct tax at 2%. But assessing officer was always disputing the fact that no, this is technical service, so you should take it under 194J. That time it was 10%. So to mitigate this, because there were representations that went to the government, there is some hardship if you want to do it like this, cash flow issue, all those things industry would have put it across to the government. So government was kind enough to consider those things and reduce the rate of tax for fees for technical services to 2%. Now has the dispute stopped? So now there is an overlap when you see the term technical is appearing under 9 also, fees for technical services. It's used in professional services definition also as technical consultancy. And surprisingly, when you read explanation, when you read 9 itself, when it is defining fees for technical services, you find that it is sandwiched between the terms managerial and consultancy. What I would like you to note here for the moment is that both managerial and consultancy services has some human element, just like any of those professions like legal, accountancy, medical, all those professions where there is a human element involved. Even in managerial and consultancy services, that is basically there. So this particular point, I just want you to keep note of it. So now let us, through judicial precedents, let us try to understand what is the meaning of profession. Because profession in Income Tax Act says profession includes vocation. It does not clearly say what exactly is profession. So if we need to understand profession, we have to fall back on to see whether there are some judgments from the courts. So in one such case which I was able to pick up here, I just put it across. This is a case of Ram Kripal Tripathi, wherein actually, I'll just give you a snippet of this particular case. He was basically a Vedanta philosopher and preacher, and he was given a car by his students. So assessing officer came back and said that this is basically a receipt in the nature of profession, because the car was given to him when he exercised his vocation. Teaching Vedanta was also a vocation which comes under the scope of profession. So in that scenario, I would want to treat that as income is what the assessing officer had mentioned. So in that context, the Allahabad High Court came back with a definition for profession. What is profession? Profession involves an idea of an occupation requiring purely intellectual skill or manual skill controlled by intellectual skill of the operator. So the fact that they are emphasizing on intellectual skill is very important here in profession. So when intellectual skill has to be involved, that means there has to be a human element, which I was just pointing out to you, which is common even under the meaning of profession, which is also there under managerial and consultancy services. So unlike business is mostly there is a repetitive sale which you keep doing, there's not much of a intellectual skill that is involved in that case. In the case of business, it's a repetitive transaction that you keep expediting every time. So in that scenario, if we understand profession, does it really resolve the situation of technical sitting between managerial and consultancy? Why am I saying this? Because there have been judicial precedents in that case also wherein they tell that, say suppose a term is sandwiched between two words. You may have to essentially draw its meanings from the word preceding it and the word after it. So in this case, managerial and consultancy is sitting on each side of technical services. So technical can again be treated as profession itself, even under explanation too, when you go for that. When you see it, the complication seems to be, it is not getting resolved in this particular scenario. So in explanation too, when it is sandwiched, managerial and consultancy also involve human element. So that rule of nociter associus is what I was just mentioning, which has been quoted in Bharti Cellular and these cases by the court, saying that the words before and after will essentially give the meaning to the word also here. So in this case, there is always scope for litigation even under the current scenario. You have the assessee taking the liberty of calling something as technical services while the department coming back and saying it is fees for professional services. We don't essentially have solved the problem. But if we analyze it a little closer, there must be some solution for this. We have to take a stand. We can't just leave it at that. Of course, the easy way out is saying that when you are in doubt, deduct tax at a higher rate, which was emphasized by Kota Sarvan in his presentation. But despite that, if we have to logically understand what is the right position, possibly one way of looking at it in my view is that you basically see what is the level of intellectual skill that is involved here. So when there is a dispute, when there is something which is the job requires very highly specialized intellectual skills, you have to judge what is this intellectual skills basically. Is this intellectual skill something which the person would have acquired through rigorous training, like for chartered accountancy? We go through a rigorous grind and then only we are qualified to be chartered accountants. So if that kind of a person's involvement is required for that particular service, then possibly even if it is a technical consultancy service, we have to classify it under profession. But if it is a job where there may be some technical knowledge which the person essentially needs to have for rendering that service, you go to him only because he has a bit of technical knowledge in that domain. But it need not be necessarily that the person has to undergo some kind of a rigorous training program or anything. Even after the person has joined employment, he could be groomed by his employer to do those things. So in those scenarios, that kind of services, possibly maintenance contracts for sophisticated machinery, if you take it, you may require the services of maybe even a diploma holder who is groomed for that, but he has that background to do that. That could possibly qualify as a fees for technical service, and you could still do 2% TDS there. While any other service which requires the services of a professional who is competent enough because of his rigorous training that he has undergone to actually advise you or provide some service in that particular area, then please see if you will have to classify it as fees for professional services and deduct tax at 10%. But you still need to be mindful that whenever you do 2%, when you choose to do 2%, you should have your documentation correct to see if tomorrow you are questioned by the department, why should I not treat that you as an assessee in default and call you have short deducted tax, even though it is under 194J itself, you have not put it under the right classification. This is a situation wherein within the same section you have not chosen the right rate. So still they could say there is a short deduction. Any questions around this?
Yes, accounting, not chartered accountant, accounting and auditors, whether it comes under technical service.
So that is what, so back office operation essentially. So it may require in the back office operation for accounting, possibly when you set up the processes, you could even have a BCom graduate or even a person who is studying that particular subject to address those, because of your processes are strong to take care of those things. So in that scenario, it may not be work related under 194C because it's in the nature of a service, if I would want to just put it bluntly there. Since it's in the nature of service, but it is not requiring that kind of a rigorous training to do that because your processes are there to take care of it, you could still classify it as technical service.
Can you give some examples of technical service?
I have this circular which is there under 715, there we have some illustrations. Possibly when we are discussing that, you will be able to appreciate some more examples in that scenario, which could qualify as a technical service. Any other questions?
So I have a question, like suppose somebody uses AI or ChatGPT or it's like when you provide service, so where does it fit?
See,
It be 2% or 10%?
see, ideally, you will again have to test the skills of that person. What is the level of skills that is required to use that ChatGPT also to give you that particular output? So he may use ChatGPT for, say, suppose a lawyer. You approach a lawyer, he uses ChatGPT to draw basic opinions, which he will work on again. Then possibly you still have to do 10% itself. But if it's some basic search where a travel agent or somebody who use their services create a beautiful itinerary and give it to me, I think using ChatGPT he does it, and he charges you a fee for it, I think you should still classify it as a technical service and do 2% for those kind of services. It again depends on what is the nature of service you are seeking from that person who was using ChatGPT. What problem you are trying to solve.
lot of chance for ambiguity. You're not always good. 1%, 10% increase, high skill or low skill, okay, it is a skill.
See, there is
Skill
a,
is a skill.
there are certain principles. Okay, so if your client is aligned to your argument saying that you have to do it at 10% because of these skills and all that, then it is fine. But if he has a counter argument, possibly you will have to create the documentation to support the argument of the claim, so that he is justified tomorrow if there is to establish that he is being bona fide in doing that. He has taken adequate care to judge whether it falls under professional services or technical services, and then only taken it. That is just with the intention to protect himself from being caught assessing default. If he is able to establish the bona fideness, he did not casually do that particular thing, then it's okay.
Even a BCom graduate also, they will tell 3 years rigorous training.
So that is what it is, very subjective in this scenario. It's very subjective. So then you have that protection always, deduct tax, when in doubt, deduct at the higher rate.
Become honors.
So deduct at the higher rate. Section 194C, just I will quickly run through the basic part of it, because when we are discussing the circular under 750, which has the FAQs, there we will have more insights into 194C. I would just want to cover 194C, 194H and 194M also, and then we get on to the FAQs. So 194C is a payment to contractors, that we are all aware. Payment to by a specified person. Some 12 types of persons are listed, like central government, state government, trust company, firm, and all those people who have to do TDS. And payment has to be done to a resident contractor, and it has to be for work. Payment to a contractor, for 194C you find one specific clause which also says that if it is for personal purposes, 194C will not apply. If the consumption is for personal purposes, it will not apply. So what is crucial in 194C is we have to be very strong on the definition of work. Work is again here an inclusive definition, which means that whatever is listed here and whatever other practical scenarios you may face, is it identical to any of this is what you basically need to judge to see whether it falls under the scope of work. So work, explanation 4 of 194C says that shall include advertising, broadcasting, telecasting, including production of programs of these purposes, carriage of goods or passengers other than the railways, catering, manufacturing to customer specification where materials are procured from customer or his associate, basically shop. So if at all you are manufacturing by purchasing the material from, you are doing it still for customer specification, but you are not sourcing the material from the customer only, then it is not coming under scope of work. It is basically you manufacture on your own account and sell it. So it is not under 194C. But if you are doing a job work, it comes under the scope of 194C because you are doing it as per the specification of that particular customer. So this is a broad insight about work. I will not get into too much of details here. When we are doing the FAQs, we can just get into it. Now I move on to 194H. 194H deals with commission of brokerage. So commission of brokerage, it clearly says explanation. Again, what is commission of brokerage is what basically every TDS provision when we are looking at it, we may have to first look at those explanations to see what comes under the scope of that particular provision of this. So it says that commission of brokerage includes any payment received or receivable directly or indirectly by a person acting on behalf of another person for services rendered not being professional services. So first we will have to make sure that that service is not coming anywhere under 194J's definition of professional services. Then it is for the services in the course of buying or selling goods. It could be, this is an RR situation. The payment which he is receiving directly or indirectly because he is acting on behalf of another person could be for services in course of selling and buying of goods, or in relation to transactions relating to an asset, valuable article or thing other than securities, because that is separately covered. So like real estate brokerage which you receive, all those things are intended to be covered under this particular definition. Here I thought it's better to just discuss this particular case study once here itself to understand the scope of commission better before we move on to the next provision. So this is a situation. I just read out this particular case study for you, which will help you to understand how you basically identify whether that falls under commission or it is under some other section or no TDS itself applies on the transaction per se. So when you are going into this case study here, Airtime is a cellular mobile service provider. In order to sell its starter kits and recharge vouchers, it has engaged several parties through its franchise and distribution agreements. These kits and vouchers are sold at discounts to their printed price to these franchisees and distributors, who in turn sell it to the same to the retailers and customers. This is the facts. These are the facts. Now, AO has contended saying that Airtime is required to deduct tax on the discount because it is indirectly in the nature of commission. You see the definition of commission there. Received by any person directly or indirectly when acting on behalf of another person. So they say that indirectly that is called as discount. It is commission has been camouflaged as discount. So why should I not say that you have failed on deducting taxes on discount? It wants to hold Airtime as assessing in default. So what is the views here? Whether the assessing officer is correct in this scenario.
Whether the recharge vouchers, if the person, if you could not able to sell again, he can sell back to Airtime.
There is no such thing.
There is no such thing.
There is no such thing.
Then it is like a purchase of goods.
It's a trade discount, then you can differently.
It's a trade discount.
It's a trade discount.
It's a trade discount. So this.
They might have an agreement, sir. This franchise, the manufacturer, this Airtime and others. There might be an agreement that you have to distribute so much.
No, that may be targets. There may be targets. And one more fact which I just want to give it to you here is that Airtime continues to have the ownership of the kit or the SIM. Ownership primarily rests with Airtime here. That is one more fact which you should be aware when you are giving me the answer. Because in a principal agency relationship, what is primary is the ownership of the goods does not pass on to the agent. And these distributors are these people ideally project themselves as Airtel itself, with at least one small board put across saying Airtel outlet or whatever they want to call it. It's a Airtime here. The fact is that it is Airtel. The cases are not Airtel. That's all. So this
property doesn't pass on the it's like only commission payment. It's commission.
Pardon? Can you come
The
back?
property does not pass on. Ownership does not pass on. It's like the commission. You cannot take it as a owner. Then it will be agent commission. Then it's TDS will apply.
TDS will apply even if it is a discount.
Exactly.
Okay. Any other views? Considering this new fact which is available to you, is your opinion changing?
Any conditions are put forward through this agent?
No, there is no such conditions at least. Airtime is not imposing conditions.
It's commission only.
It is commission. Okay. So actually this particular case is in the context of again Bharti Cellular. There were some states which held this as commission. There were some states which held it as not being commission. The same facts. So finally the matter went up to the Supreme Court. So when the Supreme Court heard this particular case, they laid down some tests for determining agency. When do you say that agency exists? So what basically the Supreme Court first asked was, can the distributor alter Airtime's legal relationship with customer through its negotiation? So just to cite an example, what it means here is, this fellow goes and tells this, he's a distributor, he goes to the retailer and says, it's an outlet, you buy these many packs from me, I will negotiate with Airtel to give you some extra talk time. Can he do that? Which obviously the answer was no. So this particular distributor or retailer is not in a position to influence the Airtime to adhere to the promises which he intends to make to get the sale executed. So that was clear. The second fact was, does Airtime exercise significant degree of control over the business of the distributor? So generally, in a principal agency relationship, the significant control would be in the form of geographical jurisdiction. They define saying that agent can operate in this particular jurisdiction or territory, or he can sell it at this particular price. So that is also missing here. So Airtel clearly told that it has no bearing on the price. That particular retailer or distributor can sell it at the price which he wants. So in that particular scenario, that is again not a I have no influence over that or control over it.
Sir, price is okay. Location, sir. Location.
Even geographically, they are not defining where this particular fellow has to operate. He can sell anywhere across India once he buys those packs from them.
If there
So
is
that
any
was the
location
fact.
restriction, then there will be issue.
So ideally, all these conditions should have been satisfied together if for that person to qualify as a fitting into the definition of commission or brokerage under 194H. Otherwise, it's fine. So the next question that they ask is there a fiduciary relationship between Airtime and the distributor, mainly because Airtime retains ownership of the prepaid SIM cards. So I was mentioning this particular fact. This fact actually changed the opinion of Sardar. So it is he basically mentioned saying that since the ownership is not passing, I think there is still a fiduciary relationship. There's a question of, he just like a principal places the trust in the agent, entrusts his stock without transferring the ownership. There seems to be something like that. But another dimension to this is Supreme Court went to analyze why is this even required? Is this a necessity for Airtime to do it? So when they went into the matter, they found that it is a regulatory requirement. Department of Telecommunication imposed that as a requirement. If that requirement was not there, Airtime would not be required to do that particular thing. So which means it is not by normal business practice that they are retaining the ownership of the SIM card, but because to comply with the regulatory requirement. So that again failed. So lastly, can Airtime oblige the distributor to render its books of accounts? So can it even scrutinize what is the sales you have done, what is that, are you genuinely claiming this particular turnover and all that? You can't even screen that. It is just their accounts. They are sale, they buy, they sell, and they declare their profits. It's just their gross income. So in that scenario, all these conditions were not fulfilled. When these conditions were not fulfilled, ideally, Supreme Court came to the conclusion that whatever SIM cards, prepaid cards, startup kits is being sold by Airtime to its distributors is just a sale transaction. There is no commission involved in this, passed on to that person indirectly also. So these principles will help us to understand whenever in the context of any of our claims, if the transaction is not very straightforward, if there is some kind of a doubt as to whether it falls under this particular transaction, if it prima facie appears as a pure sale, but there could be an agency element into it if you want to explore that. These canons which Supreme Court has basically given should be adopted and see what are the answers you could get for this. Basis that you could decide whether 194H should apply or no TDS at all if it is a straightforward sale transaction unless it falls under 194Q again. So this is one.
So as of now, the Airtel and all this Airtel SIM and all, they are detecting, but it was 24 decision on Supreme Court.
Yeah, so this is
So I think
basically,
from now they will-
again, this basically what you will have to see again is what is the position or engagement with that party where they are deducting. So if they are saying that he is an independent retailer, he is free to perform any other business also with that, he is doing this as a main activity or whatever, you need to see those contractual arrangements. So in the facts of this case, what this particular set of retailers and distributors whom assessing officer had a dispute with, what was their engagement is what we have to see there. So maybe in the context of your claim, you have to see what is their engagement. Basically, is he actually performing all the duties like an agent only, where there are a lot of restrictions for his operations and all that imposed by Airtel. That is the case, it's highly unlikely that he can come out of 194H.
Sir, if this case is taken as example, I mean, if something contrary happened, then any goods or any manufacturing company who is having a distributors, then in every case there will be issue, no sir?
No, that is what, see, distributors even now, you need to see the risk that is passed down. So the contract becomes very crucial here. So when there is an agency relationship, which is very clear in the contract, that you are only selling on my behalf. The first question when you are answering, what answer you get, that is itself sufficient for you to decide whether there is an agency or no agency.
Because in manufacturing any food product or anything, any manufacturing, okay, this distributor we will sell to the distributor and distributor will sell to the retailers. Now in case a distributor he could not able to sell within the time, within the expected, then again the company will buy from the distributors. It is like a ownership, there may be chance, no sir, something.
No, see, there may be a clause which says that, okay, I will buy it, I will take it back. It could be a purchase return.
Yes.
It can be a purchase return because that is the way the document will go. It may not necessarily be that I am owning the goods, you are not owning the goods, sort of a scenario may not be there. There is
Ownership,
investment.
yes.
So that is basically what you need to, whether the fiduciary test is being satisfied is what you need to evaluate.
So in the case of real estate, sir, the person is entering into agreement with the seller to buy the land, but ultimately you will not buy, you will find another buyer to land, okay? That, say example, it is land worth rupees, SR value 70 lakhs, and seller is paying 30 lakhs to first agreement holder. Sorry, second buyer will pay 30 lakhs to first agreement holder and 70 lakhs to owner. So seller directly registered land with the second buyer. So whatever the 30 lakhs received by this person is a commission or
So now you need to see that. See, first of all, when the first sale was happened,
it's not real, it's
agreement, they have signed an agreement.
Yes, sir.
So the seller was obliged to sell it to the first person actually.
Yes.
For some reason he gets a better deal. That is what.
Not buyer, seller find buyer itself, first buyer itself find another buyer to the land.
So there, when that is the situation, like without registering the property, he wants to basically sell that property and he will take some portion, give that seller the original amount. See, in this particular scenario, that becomes more of a business income itself. So when you see this, even in the context of the case, let me just give a little different example here, wherein the same seller has entered into an agreement with some other second buyer because he got a better deal, but this fellow may cause problem of blocking that particular deal. So he pays him some compensation for that. That compensation comes under 28 subsection 5 of income from business or profession, not compete or not do any of those acts and all those things. So it is very identical in that scenario. So if you take inference from that, this also is the main core business of this particular person. He has bought this land, then he has sold it. In my view, it's basically, in a way, when you see the transaction, even though the document may not flow like that, the object of paying something to him is to ensure that this fellow does not cause problem is one interpretation which one could take there. In that context, this person who never registered the property in his name should treat it as one lump sum business receipt.
So all these conditions like tests or examination, all should be made like cumulative. They should,
This has to be seen as a cumulative thing to satisfy everything.
you're not
Only
taking
then
it
that
as a-
agency thing
you
becomes.
cannot take it as a one-off condition.
No, you have to satisfy all these things for the principal agency relationship to exist. If one of these is also not there, then it is highly unlikely that you should call it as commission.
If they say code, these conditions have become paid as a result of code decision or it has been incorporated in the act itself.
No, see, Supreme Court, if it is bringing out something to give clarity, that will remain as the law of the land till it is enacted again in the legislation once again.
So in my case, that 30 lakh issued by this first agreement holder, it is taxable under
Business. And I feel it should be under 28%.
But his intention is not to do the business, sir. It is very one or two business.
Now, sometimes it can be even that casual transaction that would have happened. So worst case, if you does not want to call it as business, also you put it an income from other sources.
Other sources.
Sir, even extinguishment of rights also.
Now, if you see, if at all it becomes a tripartite agreement, wherein when the sale is getting executed, then you can even classify it as capital gains because there's an assignment of right. But what he is saying is that person will never get pictured in the transaction itself. He will make sure that that seller registers the property to the new buyer. He will remain in background and receive the money.
This is happening, sir. This market is happening.
So that is basically done by most of the real estate consultants.
Yes.
That kind of transaction. So real estate consultants, when they do that, that is one part of their business itself. So one is identifying a property, the other thing is to take some margin and make some money out of the process.
Now it is, we are put it under income from other sources.
Yeah, so ideally when you see 28.5, if you interpret it that way, it goes into, if this fellow has to be paid, there is no reason why this person has to be paid in the first place. If a reason has to be imputed to it, it has to be because he has been a party to that sale agreement, and he should not cause problems. You pay him something is a broad understanding. If that is the case, you take it under 28. If you otherwise you take it under income from other sources. But the challenge, my fear here is when you take it under income from other sources or anything, the chances are, will they call it as unexplained income? You're putting it under income from other sources, and then I want to tax you at 80%, and those kind of things should not unnecessarily come up also. So, in my personal view, I think.
Sir, when it is supported by a proper agreement,
This agreement, is it going to be, if he is going to use it to his advantage, fine.
He is just hiding or he is not.
If he is concealing it.
Exactly, definitely will be income, unexplained income.
If he is concealing that particular transaction itself, because the buyer would not even know that this fellow has signed up or anything, he will say, you pay me, I will pay that fellow.
or through this party.
Some
this
channel,
party.
or he may say, you give me this, you give me that much, whatever arrangement that may be there. So then if the documentation is not sufficient to back up your stand, and you show it under income from other sources, there may be challenges. It is very important that you create a proper trail of documentation to support it.
Then there will not be any issue.
So coming to 194M, why I am bringing 194M is because it is somewhat based on 194C, 194H and 194J also. So there are a few sections which Kota sir in his presentation had pointed out that personal expenses are also subject to TDS. When you are incurring costs, one could be 194 IB rent which is being paid. This is another section, 194M. So I'll just quickly take you through this snippets of this particular section. It's applicable only to individuals and Hindu undivided families. TDS will be done by these individuals or Hindu undivided families only when the payment is being made to any residents. And what kind of payments are these? These payments should be either contracts for work or professional fees or commission. So where no TDS is required to be done by the individual or HUF, either under 194C, J or H, then 194M would trigger. As I was earlier mentioning to you, 194C has a provision saying that if it is a personal expense, 194C would not apply when it is contract for work. Falls under 194M if it is a nature of personal expense. Having said that, we should not straight away assume that 194M is only for personal expenses also, because these sections 194J, 194H, 194C have one more proviso, if I am not wrong, in it, which says that this particular section will not apply to an individual or a HUF whose turnover from sales has not crossed 1 crore in the previous year, or by exercising profession it has not crossed 50 lakhs in the previous year. In those scenarios, those individuals or HUFs also, if at all they have made these payments and it is satisfying the other conditions of 194M, they also have to comply with the provisions of withholding taxes under 194M. Are you with me on this till now?
Because I have constructed our house property, I take the help of architect. I paid 1 lakh rupees. You mean this, you have to deduct.
Yeah, that transaction you definitely have to examine. But of course there are thresholds for this. So subject to those thresholds, those transactions definitely qualify for examination under 194M. So the rate of TDS here is 5%. Please note, if you had gone into the standalone sections of 194C, probably you would have got 2%. Or if you are paying to an individual, you would have got a benefit of 1%. Here, even if it falls under the scope of contract of work, you have to do TDS at 5%. There is no requirement for TAN here. Through TAN you can remit. 26 QD is the form which you are going to use for 194M. 16D is the certificate which you will be issuing. The threshold here is what is important. No TDS is required to be done if the payment or aggregate of payments during the financial year does not exceed 50 lakhs. So if it is 50 lakhs or more than 50 lakhs, you have to bring it under the scope of 194M. So like sir was mentioning earlier, if at all you are given a full contract for the construction of your house to the architect, he brings in his engineering and contract team and carpenters, interior decorators, everything as a comprehensive package and gives it to you. You do it, possibly under it qualifies as a contract for work, which means if the payment which you have made to him is exceeding 50 lakhs, you will have to do TDS. But here, one more twist to this. What if he gives you a separate bill for materials and separate bill for his services? How do you evaluate it in this situation?
Go by contract.
So
Contract if it is mixed.
see, sir, will you even, when you're building your house, will you first take a stamp paper, write a contract with your engineer, or just go to his office, say this is my requirement, these are my things, this is my budget, and just how often do we really create a contract? When you're dealing with, this is a personal expense.
First, for example, now few companies are there offering you to do construction of houses. Like some are there 2000 per square feet, like that they will charge. Don't exactly remember the name. They are all standardized formats.
That's right. So when they themselves are going to approach you, with the concept, before we start work for you, I want you to sign this contract, understand the terms and conditions. Contract is definitely a basis for it. Okay. So which means, in that scenario, a person who is so well versed with creating a contract for you would have thought of how we should deal with this situation. So in that situation, even if the contract is saying, okay, there will be something material separate and the services separate, I'm going to do it. How would you evaluate the applicability of 194M in this case? Any thoughts on that?
So 194M talks about only worker. So goods will not come, sir, if they give. The other thing I have to check.
Any other thoughts, sir, from your side?
So actually, why the threshold has been 50 lakhs? Because maybe they are referring to high value contracts. Is it? Otherwise,
This with
nowhere the TDS is already more. Most of the cases it is in thousands. Why they made it 50 lakhs?
No, because they may not want it to be so common. You see, amendments keep happening. So first time they test it, then they gradually bring down the threshold so that more transactions come under the scope of it. So they may have various factors like what is the inflation, rate of inflation, what is the kind of average cost which is running in this particular type of contracts, which particular transactions they are interested to even capture. Possibly only construction contracts they want to capture in that work. Rest of the other things or event management they may want to do. Because Indian weddings are so elaborate, people tend to spend a lot of money on weddings. I think these are the two things that they just want to evaluate.
That is aggregate payments for entire people or any person to person?
Person to person. So now one possibility which I would want to mention here is, say suppose if it is a works contract which is having it's a composite contract where in material and this you are not basically separately identifying the cost, then you have no choice but you have to do TDS on the entire thing. But suppose the arrangement is so meticulous that he gives you the bills with the name, your name only on the bill. Very proximate to the pure agency concept in GST, he takes care of that and addresses it in that meticulous way, and he is clearly able to establish that he is not taking a markup on any of this. I have paid this much, I am giving you the bill, you reimburse that to me. If that kind of a meticulous approach is taken, possibly you may not look at work at all in that case. But can it be just professional services? And if it is professional services, is it crossing 50 lakhs on a standalone basis? You will examine that as well. So this way, you may have to use your judgment to see whether you are falling within the scope of this particular section or falling out of it.
It is better to do some contract drafting here. For material supply on the contract.
Yeah, so as sir was mentioning, I am sure those kind of companies which are more organized sector who take up construction, they may have that kind of clauses embedded in the agreement itself which says that I will do these activities. Materials is yours. Even though they give me that experience of not having to go for hunting for materials around, they take care of sourcing it and using it for construction. Despite that, on paper they make sure that everything appears as though you have procured the materials and you have paid for it. That kind of a meticulous clause introduced in those contracts could protect you from triggering 194M. But if that is not there, I agree with your point saying that whatever bills you may do, the basic contract is saying materials plus services, then you may still have to just avoid that risk of saying no, I will stay out of 194M, simply go ahead and deduct taxes here.
Year afterwards we can guide the clients.
Yes, sir?
Year afterwards at least we can guide, we know this.
Yeah, so basically you will have to see any of your clients going in for this major construction of houses or anything like that. You will have to just keep screening whether they come under this purview of 194M, are they dealing with any kind of such situation where they have to file 26 QD and all that.
We can even split it, no, as separate electrical contracts, plumbing contracts.
Yeah, so that is what you, if you are having contracts with multiple individuals, each contract becomes a separate evaluation. So those are maybe, when you discuss with your client, you will be able to tell them, depending on the comfort level to comply with these provisions or not and all those, and their contractors, how comfortable they are. Evaluating all this, practically you can take those decisions.
Sir, you said that goods contractor has asked the goods when he purchased, no, in the name of the builder, the owner. Alternatively, he gets a bill in his own name, and if he gets a cost-to-cost reimbursement?
Ideally, I would say it may be difficult because there is no way you can establish that this was sourced for that contract. He may be doing multiple contracts. He might have purchased cement bags in his name. He could have applied those cement bags for different contracts.
But if the vendor is giving directly that bill to the individual,
What basically, whether it was delivered to the individual, the bill was delivered to the individual, but in the name of the engineer or the architect, how would you even prove it when an assessment proceeding goes on? So it all remains. What is visible on the document is crucial than anything else.
no, if the contractor comes and says, get these things from this shop, and the bill is everything is in that name, and he gets directly.
Yeah, if he does it that way, then obviously there is no reason why this 194 in your day. You have to only see on what is the payment which you make to the contractor, whether it is crossing 50 lakhs.
And if his fees is less than 50 lakhs, then there is no fees.
Yeah. It doesn't come under the purview of this because it's below the threshold. It has to be 50 lakhs or more than 50 lakhs.
And that too in one financial year.
Yeah, the financial year. Single payment or aggregate payments together if it is crossing 50 lakhs. So now coming to this 1995 circular number 715, which was an elaborate FAQ on how they should deal with practical scenarios, because that time 194C, today of course 194C, J, I, C, all these are very evolved. But then there was a lot of clarifications that was definitely required at that particular point of time. So in that context, when we read these things, I am just trying to figure out what would be its implications on 194M also. So now the first question itself which I have raised is whether payments to hospital for medical services attract TDS under 194J. So whatever might have been our logical argument, circular says yes. So now there is an elaborate treatment which an individual has undergone for either himself or his family member in a 5-star hospital. And that procedure has costed him more than 50 lakhs. So this circumstance, because there is in 194 context of 194J the circular has mentioned, it is applicable. Do you think we have to read it even for 194M? Any thoughts? Ideally, I think yes, because 194M, if you are going to see all those provisions, it is based on the principles of 194C, 194J and 194H. In that scenario, you will have to advise the client in case we have a situation like that in real life, where the client has spent that kind of money on a hospital, he may have to consider deducting tax under 194M. So, whether payment to a recruitment agency can be covered under 194C. So, the answer given is, provisions of section 194C apply to a contract for carrying out any work, including supply of labor for carrying out any work. Payments to a recruitment agency is the nature of payments for services rendered. Accordingly, provisions of 194C shall not apply. The payment will however be subject to 194J. So you see this situation in 1995, government was always tempted to push some things to 194J rather than keeping it under 194C. So now my question here is technical service. Now can I go and say that, okay, I put it under fees for technical services and deduct tax at 2%, or recruitment agency service, will it qualify as a professional service? Your thoughts on this?
But they have clearly stated that I think we should go only under professional services. Clearly given in the circular.
See, that time, in that scenario of 1995, there was only one single rate. 10% was uniformly there across the board. So today, when I have to take it, I think it is worth doing that evaluation which I discussed earlier on what is the kind of services which the recruitment agency basically provides. That kind of an analysis when we do, possibly we will find answers as to whether it is qualifying as a professional service or just a technical service where that high intellectual ability is not required. Next question is similar on share registration, whether payments made under 194C cover payments made by a company to a share registrar. So even share registrar, they are told that it is again fees for professionals under 194J, not 194C. So share registrar, possibly we can still say it is technical service and do it under 2% because there may not be high skills that is required. So you basically are asking for a few more examples about technical services where 2% would apply. So these are some instances which the FAQ itself gives us some kind of insights. What kind of nature of services could qualify as fees for technical services and 2% could apply. So maintaining a share registrar for a company may not require elaborate professional skills. So in that scenario, take it under 2%. So next question is on whether deduction of tax.
Subjective. That's very subjective. I mean, I may have very complicated software behind which actually is.
No, as far as you have a process behind it, and your human intervention does not require highly skilled people to do that particular job.
Operated software you may require.
Yeah, software I purchase it as an asset and use it. It's available for everybody. It is not. It's a standard tool which is available for everybody. Just because you're using a sophisticated tool to do that job does not mean that you call it as a professional service. So it is important that there must be a human intervention. But discretion of the human, in that human intervention, the person should be qualified to take complex decisions. In that case, you can say that there is a professional element there. But if it is a very standard thing, that is my view. Of course, if you have a counter to that which is equally weighted on that,
It's very ambiguous. I mean.
Yeah, there is an element of subjectivity. I do agree with you. I don't disagree there. But at least a direction in which we can think over on these lines. What is fees for technical services? Whether the deduction of tax at source under section 194C and 194J has made out the gross amount of billing, including reimbursements or excluding reimbursements, are actual expenses. So we have this question that in our context itself, we go on an audit, incur traveling expenses, our clients pay that, we take it as a reimbursement. Should we collect, should the client do TDS even on the reimbursements part of it? Those questions, and that is basically this particular question which is clarifying, saying that 194C and 194J basically refer to any sum paid. When any sum paid, it means that even reimbursements is part of your emoluments for rendering that services or performing that work. In that scenario, they advise that 194C and 194J TDS has to be done. Incidentally, in 2022, I think there is one more circular which came out in the context of 194R. 194R deals with benefits or perquisites. It's a new provision which had come into force. So in that scenario, they told that whenever a person is providing a benefit or perquisite to another resident resident, then if at all there is any and that benefit is triggering because of the exercise of profession by this particular person who is receiving that money, then if there is any such claims like expenses which that person had to incur but was borne by the other person, that is, the person who received the benefit, he had to incur those expenses, but the person who gives the benefit incurred those expenses, then whether such kind of payments and all will come under the scope of deduction of tax at source. In that scenario, in this circular, they told that if at all the bills are taken in the name of the person who is receiving that particular benefit or service, or who is providing that benefit, if the bill is taken in the name of that person who is providing the benefit, then there is no TDS. But if the bill is taken in the name of the person who is receiving the benefit or the perquisite, then TDS has to be done under 194R. Are you with me on this till now?
But as of now, if you go for bank audits and all those things, for expense reimbursement, they ask for separate fee where they won't do details.
No, that is correct. Say, as long as you are able to provide them saying that there is no markup, you can take the pure agency.
Actual.
When you are bringing a pure agency, I am in agreement with you on that. But sometimes we don't do that, like I don't have a separate, this is my fee and this is my, when I go for reimbursements, if the air ticket, when I am booking the air ticket, if it is booked by them or in their name or whatever, so that they get the, just to give it a little more clarity on that, this I would rely upon the same clarification in 194R circular, where it says that who is claiming the GST credit. They go on to go that extent. The person who is taking the GST credit, if at all the bill is raised in the name of the client only, he gets the GST credit, then it's okay. There's a pure agency that is getting demonstrated there itself. But if nothing like that is there, you have booked the ticket yourself, it is under your PAN, your GST number and all that, then obviously he will not get ITC credit, you will get the ITC credit. So even if you are claiming it actuals, it's basically your expenditure which you incur for earning that income by rendering those services. So you still have to do, TDS has still to be applied on that amount also. That is the logic which this particular question 30 brought out in 1995.
But presently it is not being followed.
Presently also what is happening, you are actually going across for bank audit, just giving them the bills on hand there itself immediately.
Not on hand. They will say that after 1 month you can give the reimbursement. Our travel, maybe travel, sometimes flying, all your local expenses, everything will be put in our name. We are reimbursing it.
No, that is what I said, when it comes into the scanner, possibly it could get open for disputes on these lines. That is, the banks could still be held responsible for not
There
having.
is a circular, there is a subsequent judgment in this.
So in this, but there is a judgment also that came up, but it's a different context which we need to read in this. I will come to that also. So when you read that particular provision under 194R, what guidance they gave, they are mentioned saying that the bill can be taken in the name of that particular person who is giving that benefit or perquisite, then there is no need to deduct tax on that reimbursement. So the same analogy, if we use it here also, in this 1995 circular, which deals with only 194C and 194J. In that context also, in my view, you could actually draw inference from the latest circular and say that since the bills are all in the name of that particular claimant only, it's a pure agency which I can, if I can demonstrate pure agency which is defined under GST Act, if I can bring it here also, I think we can still exclude it from the scope of TDS. So possibly banks may have to see how they can defend themselves in that way. So that is one thing.
So in the case of paint industries and cement industries and insurance companies mainly, for turnover, they achieve the agent or distributor achieve the specific turnover criteria. They will send for abroad, foreign trade and board free of cost. That means that is they have to deduct the TDS.
Yeah, that is a provision under 194R. It comes under clearly under the scope of 194R.
We have to collect the TDS amount from the agent and then we have to deposit to the
Yeah,
bank.
but the guidance is a little different there. When in the circular they say that you have to ask them to pay it and they will pay it only as an advance tax. That is the kind of guidance they are given in the circular.
So the parent company will pay advance tax.
No, like he was taking the example of agent. So if at all the benefit here the agent is receiving is in kind. So when it is given in kind, obviously the person who is giving the benefit cannot actually deduct cash and remit it to the government. So in that scenario, before he even gives him that benefit in kind, he has to make sure that that fellow has paid the tax. The agent, that is the dealer or the agent, has paid the tax applicable on that benefit or perquisite.
How it will happen?
So that is where he has to evaluate his income. What the circular is saying is it has to go through as an advance tax. So that fellow has to see what. So now
No, who will pay advance tax, sir?
the dealer or the agent, he will pay that.
No, practically, I also have same thing, that is why I asked.
So the workaround that we always do is we ask him to pay that money and deposit it through our TAN, and we will file the ETDS returns to keep it straightforward and simple. But the guidance which they have given is because possibly they cannot give
Over
it.
and above the section, sir, because advance tax, if I get something like if I am in 30% slab,
That is a practical issue.
30%. 194 are 10%.
So, so you forget that if there's a situation where the dealer says I am not taxable because my income is and he doesn't pay advance tax, then what happens when they say advance tax? So possibly we will have to.
the filing of return get refunded.
So we will have to insist that they at least pay 10%.
10%.
If the circular says advance tax there. If the circular had at least, possibly they can't put it on paper saying that you collect the money remitting your TAN or something like that, which is for the prize money and all, which practically that is what the way it is done.
How this travel, for example, foreign travel benefit is given? How the agent will show in his books?
See, till now that was the problem. So as I was telling you in the beginning of my presentation, that some of these sections which have been introduced are to make sure that certain transactions which we were not reporting as income get reported. I may be filing my tax returns. So the agent has regularly been filing his tax returns. But this intangible benefits like travel and all which he basically got, he never brought it into his books.
Correct, sir. Now assume that agent is a company. He has received a foreign travel benefit. How will he report in his books?
So in his books it is, you cannot see there's an accounting entry at all in the first place.
If I don't show, then my income tax return will show there is a difference in income reported, income tax
So he will
return
have to
will not get
separately
accepted.
disclose that as under 28 he has to pass. Maybe now once that perquisite tax is deducted, so there is a value which we are going to derive for that. The value will be basically the expense which that say Asian Paints will pay for his tickets. That becomes his perquisite value. So that comes into the books. So he may have to just put that as income there by say debiting Asian Paints to that extent and crediting a special receipt or an income as 28 subsection 4 this quality comes under. So benefit or perquisite. So a lecturer head as benefit or perquisite should come into his books where he credits that and shows it in his P&L. Once he has gone through that particular journey and all those things, he may have to just close it as there is no question of again receiving that money from these people. So he may have to knock it off against the director's personal account or anything in the company if there is some kind of a loan or anything which is there. If it is his personal enjoyment which he goes for the trip, so to that extent they may have to offset it.
See, this problem I faced. I approached the assessing officer. Officer also had no idea of what to do. We filed in tax audit report also, it got rejected. It shows your income reported and what is shown in your ITR is not matching. Again, we have to amend tax audit report and upload.
Okay.
What is the standard practice I want?
No, the only way if you want to bring it as an accounting entry in the books for this, based on that valuation which will be available on your 26 years and AIS, you will have that certificate which comes in. The only way which you can pass is reporting it as under a new ledger, because from the accounting principles or accounting standards, it is quite difficult to see how you are going to bring this into the books. But if you have to reconcile it with income tax, in tax computation you may have to make the change. In tax computation you may have to add it.
In cash computation only we added, we did not show in books. Then income tax return got rejected. It was not getting accepted. Tax audit report also got rejected.
Because these are all initial stages of litigation, and in this particular case,
When it is newly introduced, at least some guidance to be given. Otherwise, we are facing a lot of problems.
you have if this matter has to be understood by the department, it is only through appeal procedures where there will be some court pronouncements which comes in.
That's why I raised a grievance and went to assessing officer. He also told I don't know. Then they called another CA, or expert CA. Then he told put it under in business income only.
It has to be shown under 28 for the tax computation in my view. Because accounting standards, there is no way you can, if it is a company and bringing those kind of things into the books, I can't think of an accounting entry at least directly.
There is a problem, sir. Practical problem is there. Idea will get rejected.
No, but the fact that it is 194M, when you are actually sure, it does not qualify, sorry, 194R, it does not go into a sales turnover or anything. So to get it, for the ITR to get rejected also, I really cannot understand why there should even be a rejection, because your turnover would be matching with your GST returns, with all those filings. For this, there could be one more trigger or dimension to this if you show it there in the turnover, because no GST would have been paid on that. Again, so what would be the implications under GST is another thing which may have to examine in that scenario also. So this anyway, I'll skip this particular case. It is basically justifying, this was a position before the circular of 194R came in. So reimbursements possible, court had held in this case that reimbursements are, there's no reason why you should do TDS. If it is just somebody else's liability that you have won and got reimbursed of that, there is no TDS. That was basically what the court had clarified in this position. So that inference is what I am just drawing even for 194C and 194J. So even in 194M also, these things could still be relevant when you're looking at the threshold and determining what is the threshold. You can also see whether there is, of course, GST is one thing which we should exclude from it. Whether it is 194M or 194JC or anywhere, GST we cannot take it to the threshold.
There is one more problem. Wherever there is no requirement of TAP but TDS has to be done, there you cannot revise it once it is done.
I think there is a procedure, like 26 QC QP and not can be revised. There's a procedure
Other than TDS revision is not done.
No, in 26 QP, at least I have come across, only thing is there is an approval process that is required from the seller and the assessing officer also. The process is tedious, but amendment is possible. There are fields which can be amended. Say suppose you want to change that seller span, you have entered the wrong seller span and all that in 26 QP. Consent of the seller, then the assessing officer's approval, that is the process. There is a process of that amendment.
Now 194R, sir, it is becoming a little bit bigger in a company also. Say till now certain vendors or customers know, they will give certain gifts to employee, where a company also doesn't know and they had a policy of not to accept them. Now because of this 194R, in this 26 days they were able to get, and when they are going back now, they are able to get the employee information also. 194R, practically this happened.
So that's what, see, the thing is the benefits which the government gets from each of these things is humongous. So you can see the innovation that has gone into the engineering the TDS provisions itself. So quickly, 194I, this is basically means any payment by whatever name called under any lease, sublease, tenancy or any other agreement or arrangement or use, either separately or together. So in this particular case, we always find that there's a litigation that happens because they say that this is not a tenancy, this is not a lease, so I don't want this TDS to apply. So we need to understand the words that are used in 194I, where it says that rent can be by any payment, whatever name you give it, you call it as license fees or any other name, and it need not necessarily be called as a rent agreement or a lease agreement or whatever. It's the words when they use any other agreement or arrangement for use, which has a wide import, and if it is for the use of this land, building, plant, machinery, equipment, furniture, fittings, then it qualifies to, or it's subject to TDS under 194I. So this, pardon?
Any limit to like 40,000?
Yeah, those limits are there. So those limits, like I am not basically deliberately not getting into discussing the limits, because that you may be familiar with 2,40,000 per annum. Only in those new sections I am just highlighting those thresholds. But otherwise for 194I, yes, the threshold is 2.4 lakhs per annum. So now in this again I was just trying to bring this relevance of agreement, or when you see this terms which are used under 194I, how relevant is the term agreement, how wide it is. For that, I just thought I will bring out one case study and just explain that to you, so that you are able to appreciate the relevance of 194I. So in this IT Hospitality Limited, they were the highest bidder of royalty with Airports Authority of India, wherein they were given access to set up an executive lounge at an international airport. When they structured the agreement, the license agreement when they had it, so the agreement was that this company is going to pay a royalty of 6.25 lakhs every month, and there will be a license fee which will be measured on the area of the executive lounge. So 400 rupees per square meter for 230 square meters every month. So that basically IT Hospitality interpreted as rent, because it's for the use of space, and it deducted tax on it. While for the other amount, that is royalty, which they termed as royalty, which was being paid, they wanted to call it as right to do business, and they told that it is outside the scope of 194I, I don't want to deduct tax. But assessing officer wanted to treat them as assessing default, because they argued, assessing officer's argument was that it is predominantly the agreement is for the use of that space. When you see that particular agreement, it is predominantly for use of space, you are only camouflaging it as by a new term. The definition says rent by whatever name called. So the purpose is, so I need to do TDS. I mean, so since you are failed to do TDS, I would want you to want to call you as an assessing default. So just want to know from you whether you agree with the assessing officer, or this royalty is basically outside the scope of meaning of rent.
With the officer, sir.
It's better to be on the safer side.
No, because the only purpose of making payment is to use the premises. Then whatever form I do, it will trigger, no? It is like a rent or lease.
Any other views?
The main purpose.
Royalty, otherwise there is no fee basis, sir.
Royalty naturally comes under 194J.
If the rate is same, you want to.
Sir, rate is same, no, sir. Even then you want to, assessing officer want to.
No, he has never done TDS.
He has never done. Oh.
He didn't know the TDS, he did that only for.
He is not, because his content, they may call it royalty, but it's not really in royalty. It's a right to do business. But no TDS under royalties was done. Because there it is actually for royalties, it would have been 2%. If they had taken it there.
Claimed it. See, claimed it royalty.
Yeah, so the term used was royalty. That's the thing. So this matter also, Delhi High Court had an opportunity to decide on this matter and lay down the principles. So these principles, I am just bringing it out because in our own practical cases, we could possibly pose these questions in those scenarios and find answers which will help us to decide whether it falls under the scope of TDS or goes out of the scope of TDS. So now the first check, which is they wanted for a payment to go out of the ambit of 194I, it has to be proved that payment is not in consequence of landlord and tenant relationship. So if at all it is made as a payment, not in the context of that landlord-tenant relationship, that is, there may be some other services which is coming through from that person because of which I am making the payment, wherein it can be argued saying that even if that space is denied to me, I still need to make that payment. In that scenario, then it falls out of the scope of rent because it's for something else. So it should be, when you have to say that it is not in the context of landlord and tenancy, it means that the payment should stay as is, even in the absence of that space or machinery or whatever is being provided to him. Payment is not connected with the use of premises, very straightforward. So if you can establish that it is not in connection with the premises, but in this particular case what was basically happening was, the Airports Authority wanted that space to be used only for that executive launch. It had to be set up because that space which was available was given predominantly, it was around that real estate. Payment of for various other facilities and services which is incidental to this particular land. Land itself is an incidental service there, it is not a predominant service. Like for example, in a similar Japan Airlines Corporation, they were making payments to the Airport Authority, not just for the premises or whatever, they were paying for that landing and the services which the airports render for when the flights land, a lot of other activities that they draw from the Airports Authority. For this they were making those fixed payments. So in that scenario where you can establish that that land is not the predominant criteria there, but it is various other services which is being provided also, somewhat overlapping with the first principle. So in that scenario, then you can say that this payment is outside the scope of tenancy. In composite agreements where the predominant objective of payment should be for use of premises, we have been emphasizing this. The premises is not under the exclusive use of the payer or is on a rate contract basis where the space is randomly allotted to the payer at the discretion of the payer. So exclusivity is an important thing. In this case, IT Hospitality had exclusive right over that particular space for that particular period, for which these payments were being made. So when they bring out the concept of rate contract, I would refer to again Circular 750 in 1995, wherein they brought out this concept of rate contract for hotels. So companies were actually engaging with hotels for providing rooms for their employees. So wherever the hotel was obliged to give that space or this set of rooms exclusively for the use of their employees, then 194I was triggering as rent. Wherever the company had signed up with the hotel saying that whenever my employee comes, this should be the tariff. But there is no obligation for the hotel to definitely let out that room. If it is available, they will give it. If it is not available, that's it. Or they can provide any other room. So that space is not exclusively available to that company. In that case, it was a rate contract. So they are bringing out the same analogy here. If it is in the nature of a rate contract, whatever payment you are making, then 194I will not apply. So in this particular case, all these canons when they were evaluating, IT Hospitality I think failed on all these fronts. So that royalty basically, if at all that premises was not going to be used, they would stop paying the royalty. That was the way the arrangement was. So in that situation, it is highly impossible to say that it is not in the nature of rent and they were held as Hasidic default. Any questions around this?
If the same changes, the situation changes to say they are just maintaining it and we are paying it as a maintenance amount, will that be considered
194C?
That will become contract?
Work. So next comes 194IB, again a small section, which is basically referring to the rental income. One more section where personal expense is being taxed, brought into the net of TDS. So whenever any individual or HUF is making payment to a resident in the form of rent and that rent is exceeding 50,000 rupees per month, then TDS has to be done at the rate of 5%. So again here I would like to emphasize it is not necessarily limited to personal expenses only. If that individual or HUF is having a business but is not, 194I is not applicable to him because his turnover in the preceding year was not exceeding 1 crore or it was not crossing 50 lakhs if he was pursuing a profession. In that scenario, but he is paying a rent of more than 50,000 now, that comes under the scope of 194 IA. Any doubts?
PAN is equal.
This is again this is again only PAN based.
Respect of amount we have to pay. Up to 50,000 per month.
50, if the rent crosses 50,000 per month,
Then yes.
even if it is only 1 month you have paid the rent also, TDS will apply. If it is, it is not like an annual threshold.
Sir, then if my owner is outside India,
195.
195 will trigger, I have to deduct. Even for it is my residential personal purpose.
But in 195 there is no limit.
No, 195 there is no limit at all. Any payment, even a single rupee you pay to a non-resident, you have to evaluate what is the tax rate that will apply and then apply it. And
So 195, 50,000, earlier it was 20,000, enhanced 50,000.
yeah, I think long back.
No, 20,000 is there.
Earlier it was, but now it is, yeah. Again for the purpose of removing difficulties.
So rent payable to rent, non-resident TDS to be deducted.
30%.
If it exceeds 50,000 or
No limit. Non-resident. no limit.
31.2%.
That is surcharge and
Such as this.
some points around 194 IA possibly could be of interest to you.
195.
So 194 IA,
Amen.
again it is for the TDS on payments of for transfer of certain immovable properties other than agricultural land. So the transferor, the seller of land is always a resident. Transferee who is a buyer can be a resident or a non-resident. That is, the person who is buying the land, he can even be a non-resident or he could be the relative or family member of the transferor himself. Even then TDS has to be deducted. So the rate of TDS is 1% of the consideration. The exception is stamp duty value. If it is exceeding the consideration agreed, then 1% on the stamp duty value has to be deducted. Subject of transfer immovable property being land other than rural agricultural land or any building or even part of a building. Threshold is if both the consideration as well as the stamp duty value, both are less than 50 lakhs, then no TDS. If even either one of them is crossing 50 lakhs, TDS under 194 IA will trigger. Are you with me on this?
So in the case of
TCS
joint holding,
Pardon?
giant holding,
I'll come to that.
person is paying.
So the next thing that we need to understand in 194 IA is consideration. So what is basically consideration? Again, they have added this to an explanation. They have clarified saying that that consideration for the transfer of immovable property shall include all charges, the nature of club membership fee, car parking fee, electricity, water facility fee, maintenance fee, advance fee, or any other charges of similar nature which are incidental to the transfer of the immovable property. So this is basically again in this apartment culture wherein you book an apartment, all these things are taken by the developers, they're giving the breakup of fees and this is for that. So all that was basically going outside the scope of TDS because the person used to say this is the value at which you have registered the property. But actually there could be a profit element for the developer in all this. So the government wanted to have visibility of all these transactions, so they brought in this consideration definition to include all this.
Sir, even now I will pay rent to the owner. Maintenance will come from association. I have to pay to the association. In that case, I have to deduct TDS 194 IA.
No, this is for immovable property transfer.
Okay, sorry. Transfer not even.
Not regular
Yeah.
maintenance.
Not
So in case of rent, in case of rent, the rent is exclusive of maintenance. Maintenance will be paid to the society.
No, that is what again a lot depends upon rent by whatever name called. You have to be cognizant of that in the definition there. So how strongly you build your agreement and separate those two things is important. Section 194IA, I think I just have 2 more minutes, but with your permission I'll complete this and I'll tell you how many more slides are remaining. If you are okay with it, then I could even quickly dwell upon those slides also. But otherwise, after 194IA, possibly we may have to stop. So, because it's 1:30 right now. 194IA, your question. There are multiple buyers, but one seller. Where the share of consideration paid by each buyer is less than 50 lakhs. Multiple sellers, but one buyer, where the share of consideration received by each is less than 50 lakhs. So whether TDS would apply under 194IA. Any thoughts?
The person who is making the payment to the
So if
seller
yeah.
has to deduct 1% tax and pay it. Whether it is multiple seller or this thing, each buyer is making the payment. They are not making the payment jointly.
So in other words, you are saying that it is qua the individual
Yes.
buyer. It is not qua the property.
Property.
Because it is income tax is not direct income, so it is individual transaction.
So individual transaction. So one more, I would just like to add one more dimension to this. You are not having separate absolute sale deeds, you are not drafting. You are combining everything and doing it in one absolute sale deed because property is one. If that is the case, then why should this not be treated as qua property and why are you saying here it should be qua individual? Your thoughts, sir? Individual or property? So everybody is on individual. So incidentally, I think these two cases in these two contexts, two scenarios of seller multiple, buyer multiple, both were tribunal decisions. In both cases, tribunals have interpreted it in the same way. Okay, but somehow I personally have a different view on this because when you see this 194IA2, which says that, which defines the threshold was there, no deduction under subsection 1 shall be made where the consideration for transfer of immovable property and stamp duty value of such property are both less than 50 lakhs. When they are referring to the consideration and stamp duty value, both they are referring to the property as a whole when you see it. When that exclusion for exemption is given in that particular perspective, is it right to split it? Especially in the context where TDS is something which is not a basic, it's only a cash flow issue. It is only that he will have to take credit of it later. Should the buyer go aggressive or the seller go aggressive and say that I will do it as qua individual rather than qua property? So I personally of the view that it should be qua property that we have to see, because one argument which I would also want to advocate here is there is a single sale deed which is basically done. We are not doing separate sale deeds here for each property. So it's better being on a conservative note here and taking this one. I have 52 slides, but I'm on slide number 39 now. So which means I need at least another 15 minutes to cover a little more so that we don't leave everything left out. Is that okay?
Okay, sir.
So we'll continue for another 15 more minutes.
So what about in the case of gifting the property, the donut for IA? Mother is gifting his son. His capital value exceeds 50 lakhs.
Consideration sum paid. So actually I got that also, but since you asked that question, I will just bring that out. So is there a sum that has been paid? Because 194 IA says that any sum being paid to the credit or the payment is being made. There has to be some, in one of these cases, I cannot remember the citation, but it is there here. Yeah, this case, H.S. Sri Rama Verma, Supreme Court has tried to define what is a sum when it is used in law. So Supreme Court has said that sum would mean that there has to be the transfer of money. Some paid, some credited. So in a gift basically there is no such transfer of money or anything there. Okay, there's no consideration itself.
And that was
The absence of consideration in this, and it is not meeting the criteria of sum paid. I don't think we should apply TDS in that scenario. But another dimension to this, you gave the example of gift, but I would want to put it say as an exchange of property. You give property A, I give property B to you, will 194A IA trigger. So there also when we see this logic, if one argument which they have advocated is the condition of existence of sum paid is not there when property is being exchanged. So the 194IA would not trigger in that scenario also.
Sir, but the basic provision of section 4, income tax payable, and this purpose of this all TDS, here it is there, no sir, it is directly, indirectly that barter system.
So I am not sure whether you can really go up to that. Is there a need to go up to that level is something which I am actually, I think we can get a resolution on the section itself is what I basically feel here. Even if the consideration is not there, they give that instance of a consideration may not mean money here. First, consideration is in the nature of property. So consideration exists, but not in the nature of money. And the second thing is stamp duty value is 194IA always says you have to check stamp duty value also. These properties will now be registered at stamp duty value only when they are being exchanged. So there you still have the trigger of 194IA in this case. You cannot simply take shelter as we took the analogy for gift. That may not be possible here. When there's an
Even
exchange
in the
of
other
assets.
case also mother giving, that is totally exempt, so that's
It's an exempt transaction first of all. Even from the 56, gift from a lineal ascendant or descendant is an exempt transaction. So there is no income itself in the first place. So 194 IC is again referring to joint development agreement 45(5)(a), wherein whenever there is a person who is owning some land, he gives it to a developer. Developer pays him some cash compensation in addition to in the joint development agreement. We are all familiar that there will be multiple ways of remunerating the landowner. So they would give up some cash consideration to be negotiated. Then there can also be that they will be giving him some portion of the constructed area. Now the challenge which we had was 45(5)(a) basically was to provide a relief to the landowner by deferring the capital gains declaration. Wherein they told that if you are basically given, you enter into a JDA today, you are promised a share of the new building which is there for having given up your right over that land. In that scenario, since you are not receiving any money today, I will defer the capital gain to the date when the completion certificate is received.
It is 45 years.
That is 45(5)(a). So that is the background. Now in such kind of a transaction, the landowner may negotiate for some payment in some cash component also. Cash in the sense I am not saying hard cash, it's bank transfer only, but I am using the term cash. So he also negotiates besides that asset portion as a consideration, some monetary value also. This 194 IC is for covering that transaction. So here it says that it starts with a non-obstante clause saying that notwithstanding anything contained in 194IA. 194IA is for transfer of immovable property other than through specified agreements. So wherever there is a specified agreement, I don't care about 194IA. It has to be at 10%. That non-obstante clause was relevant here for the simple reason because 194IA has a 1% there. This is 10%. So you need to make sure that that fellow will definitely deduct tax under this provision. So they introduced that non-obstante clause and told that TDS at 10% will have to be done here. So consideration, not another thing incidentally when I was just explaining that existence of consideration. Incidentally here they say consideration not being consideration in kind because this is for the cash component only. In 194IA they don't use that word consideration not being in the nature of cash. There they just say consideration. Here they want to cover those considerations which is not in the nature of kind. So that is the reason this is having that kind of a distinction also. This they basically want to cover those amounts which the landowner receives which is not refundable but it is paid to him today. It is paid to him today as a part of the entire consideration for giving up his right to use that particular land. Are you with me on this till now? So, having said that, TDS is done now. When TDS is being done now, capital gains is not offered to income in this year, because 45(4)(5)(a) says that when the completion certificate is given only, you have to declare that capital gains. So what we should be mindful in those cases is we should make sure that in the tax return we carry this forward till that year in which the completion certificate is received and we are offering the capital gains to tax.
So here only they are asking whatever the cash amount is received, that much only you can offer to tax, no?
See, the point here is, real estate is such a transaction wherein you really don't know whether it will still culminate in ultimately getting the project going through or not, so many occasions. So this fellow paying the tax now, how things may change.
Whatever the amount is received for that.
That is right. Say today, some practical situation is today that fellow agrees, JD is signed, everything is done, he receives the money. If 1 year exactly after the financial year, his brother will come and say, this fellow I have no right to even sign the JDA. So it goes into litigation, the project will never take off. This fellow will again keep fighting the case for giving this money back or not giving this money back. So where is the thing again?
Ultimate beneficiary won't like it.
So then given that particular benefit or the provision, it's okay, we may have to only carry forward that credit. The facility is there. Because ultimately, this income will be declared as a capital gain only at a later point. So how do I even compute that right now when I don't even have even the method of computing the capital gains is described at that point of time. It says that stamp duty value of the property received on receiving on the date when the completion certificate is granted. That value plus the cash consideration will be a consideration for the right which you gave up on the land. From that you reduce the cost of acquisition and you pay the capital gain, arrive at the capital gains and pay the tax. So at that point he is including the cash consideration when he is doing it there. So why pay now?
Sir, that client agreement, the owner of the land, he will not sell that his portion of the apartment. He will keep it for later. That case also he has to pay capital gain.
No, the thing is, once you have got the completion certificate, it does not say ultimately whether you sell or not. The developer has fulfilled his obligation of giving you your consideration once he has completed the project and there is a completion certificate. So what you wanted building, you wanted money. Both you have got.
But I will not transfer that, I will let it out the house.
Maybe. That is rental income, you offer that as rental income, but this one, capital gains has to be.
JD.
Yeah, JD.
Only JD. That rent is
Rent is up. Capital gains, stamp duty value on the date when the completion certificate is granted. When you sell that property, that stamp duty value which you would have adopted now becomes your cost of acquisition. 194R.
It is done in the same year, completion of the building and so there is no need to show it as two transactions.
If that, fortunately, if you got such a good developer and the project can actually get. So I'll just quickly run through 194R also. Interesting provision, but very elaborate. Whatever in the next few minutes I can do it, I will just cover it, and this will be the last section of my case reading. I think the only other section that remains is 194A, e-commerce operators, but possibly I'll skip that particular thing. So 194R, the purpose of having this 194R. So even before that, I'll just go through what is this 194R itself. I'll just read out. Any person responsible for providing to a resident any benefit or perquisite. Mind you, the words here is some paid, credited, normal standards are not there. They say providing to a resident any benefit or perquisite, whether convertible into money or not, arising from business or exercise of profession by such resident. That is, the person who is receiving the benefit should be entitled to receive this benefit because he has exercised his business or profession for which this is granted, shall, before providing such benefit or perquisite, as the case may be, to such resident, ensure that tax has been deducted in respect of such benefit or perquisite at the rate of 10% of the value or aggregate value of such benefit or perquisite, provided the value or the aggregate value of the benefit or perquisite exceeds 20,000 rupees. So there is a very low limit of 20,000 that has been set here. And they have further clarified recently, this I think assessment year 24-25 onwards is relevant. Of course, they had that intention from the beginning, that benefit of perquisite in cash or kind, or partly in cash or partly in kind, all are covered under the scope of 194R. What is the basic rationale for this? So in the finance minister's speech, she has told that it has been noticed that as businesses, that as a business promotion strategy, there is a tendency for businesses to pass on the benefit to their agents. Such benefits are taxable in the hands of the agents. In order to track such transactions, I propose to provide the tax deduction by the persons giving the benefits if the aggregate value of such benefits exceed 20,000 rupees in a financial year. And the explanatory memorandum when this provision was introduced was section 28(4). Provides that the value of benefit or perquisite, whether convertible into money or not, arising from a business or exercise of profession, is to be charged as a business income in the hands of the recipient of such benefit or perquisite. In many cases, such recipient does not report the receipt of those benefits in the return of income, leading to furnishing incorrect particulars of income. So, a scenario when I began my presentation saying these provisions are to bring into the fold those incomes which we are normally not reporting. So 28(4) was a very underreported section, though it was there in the law always. These people who gave the benefit of in the name of business promotion or the guise of business promotion, they passed on benefits to the agents. They would book it as an expenditure, but somebody else has to also book it as an income, which was basically not happening in full because nobody was complying with 28(4), though it existed. To enforce that, they brought out this particular 194R.
So only Income Tax Act has brought out, but Companies Act and Accounting Standard, there is no mention of this. That's where problem.
That's why you see there are many things which our laws don't mutually agree with each other. So we will have to take cognizance and keep finding workarounds in those scenarios. Ultimately, you have a big. So how do we basically understand what is a benefit or a perquisite? So I will just quickly run through this particular conclusions which these two court cases had. Benefit or perquisite draw color from each other. They refer to some irretrievable privilege which is conferred by one person to another. So it should be irretrievable. In the context of section 28(4), since it has to be received during the course of business or exercise of profession, it implies that there is a vested right to receive the benefit or perquisite. So that means the moment one transaction was entered into between these two people, there must have been a vested right for this fellow to receive the benefit. So benefit or perquisite itself is something, even in the context of 17, we know that it is something which the employer pays over and above the remuneration as a special privilege. So even in the context of business, if there is a business which one person is exercising, he has a normal consideration. In addition to that normal consideration, there is a benefit or perquisite which is going to be given, and both the parties are basically aware of that particular thing, that there will be such kind of an entitlement. Like in the context of this example where an agent is being rewarded for turnover, the agent always knew that when he achieves this turnover, at some point he will get this additional benefit. So that kind of an existence must be there for it to qualify as benefit or perquisite under 28(4).
So in that case, they will not take it, they will take it under 194R, this business center to agent.
Yeah, so that kind of payments, only those kind of payments which qualify under 28(4). I am using that 28(4) here because that is where this particular income gets reported by the recipient. So in that scenario, benefit or perquisite is understood like this. I am only using 28(4), the meaning of benefit and perquisite to understand it better. How we have to see it when we are implementing 194R.
No, that way the commission, it will not come under commission.
No.
It will be treated in this business.
I will just complete this particular portion and then stop. He is there already. Girish is here giving me a warning. There are these FAQs which may be a little too heavy actually to deal with it. Let me just. Okay, so with the FAQs itself, I will quickly cover it. What the guidance for in 194R, the first question that they asked is, 194R is somewhat related to 28.4. So should the person who is deducting tax see that whether this fellow will offer income under 28.4 and then deduct the tax? So for that they have clarified saying that you are not concerned about how that fellow will disclose his income. As long as when you are giving a benefit of perquisite, you are satisfied that it is actually a benefit of perquisite, as I explained just previously in those two judgments, based on that logic. If you feel it is a benefit of perquisite, don't bother how that fellow will disclose in his tax returns. You have to do TDS. That is the substance of this particular thing. Whether sales discount or cash discount or rebates are benefits of perquisites, I am surprised by they even brought out this particular question. They say that it is sales discounts and all those, sales discounts, cash discounts, rebates are actually logically benefits under 194R. That is the way the circular word said. Because I would have seen that sales price discounts is basically a negotiation between the seller and buyer. The buyer sees a certain value in the goods and he negotiates for it. And the seller, if it is okay for him at that value, he will offer it. Where is the benefit of perquisite being given in the first place in a normal discount which is given in a sales transaction? But the department has taken interpretation that logically it is a benefit of perquisite which is given. But because of difficulties in implementing the provision, I will exempt it. There is no need to do 194R. Highly illogical, but that is the way the circular is worded.
In fact, that is more quantifiable actually.
No, it may be quantifiable.
No,
but
I'm saying, when they are saying it is not possible to, difficulty in this one, that is more quantifiable.
no, but there are practical issues, madam, because that person, purchaser, when he accounts that, this fellow deducts tax, suppose, on the discount, it gets into his 26 AS. That fellow may be a consumer or may be a reseller. That fellow may not even have sold those goods. And then there is an income, that benefit is sitting there in the 26 AS, and what will he report that income as? So they switched off the lights so that I go.
You are telling some that advance tax has to go.
That is then TDS. That is a part of this FAQ itself. So when the benefit of perquisite is given in kind, there is no cash that is available for you to deduct the tax there. In that scenario, what the circular is saying is, you are the provider of benefit of perquisite, you tell the recipient, deposit tax, only then I will release this perquisite to you. So how should that fellow deposit the tax? He will not have a time, he cannot deposit it in your time. So he is saying you pay it as advance tax. When you pay it as advance tax, the point that he raised was, advance tax will be based on the estimate of income that fellow does.
So that beneficiary has to pay advance tax.
Beneficiary has to pay advance tax and provide the challan. That challan has to be disclosed in my 26Q. There is a provision now they have introduced in 26Q, which I have also not tested or seen it. But the circular says it is there in 26Q, where that challan which was paid as an advance tax can be reported here, and it has to be mandatorily reported. Now in a situation where that fellow has income less than basic exemption limit and he is having only this particular little bit of some income and this benefit of perquisite, he says I am not required to pay advance tax, what happens in such a scenario? You still have to compel that fellow to pay the tax, pay something at least, 10% you pay somehow, you will anyway get refund of it, and give me that challan so that I can give you the benefit.
It's just like that overriding the law and
Which year, from which year it's supposed?
This is all I think 2022, that when 194 was, R was introduced.
2022, July 1st.
July 1st.
It's like a circular overriding the law and
You have to litigate. But this is basically a guideline is what they say, and they say that this will be passed in the parliament after it is released, and this is both officer and the assessee has to comply with this. That is the way they brought this in. Even in that section itself it is there. So that one last thing, important question, valuation. How do you value the benefit of perquisite? Subjective, as you may come up with the same thing, that it is subjective here again. Yes, it is, because they use the term fair market value. Valuation would be based on the fair market value of the benefit of perquisite. And when they say that, they give some exceptions to it. They say that when the provider of the benefit of perquisite has purchased the benefit, then it is the purchase price. When the provider manufactures that item as the benefit of a project, then the price charged to the customers. So these are the two options he gives for valuing. Suppose you are able to quantify the cost of the benefit of a good because you purchase. Purchase is a straightforward thing. Manufacture. When it is manufactured, what could be the issues? So he says it should be the price you charge a customer. I may be charging the price differently for different segments of customers. That is one situation. I may have a seasonal sale in some period of the year. I may sell it at steep discount, and some other part of the year I may sell it at a very high price. So which price? No such clarity. Some practical issues. Of course, the circular has several practical issues. But again, due to the limitation of time, I will have to take a pause here.
So doctors who are receiving free gifts,
Free samples are
covered
also,
here.
it's also covered, and there's a very elaborate clarification on this. Free samples. Since you raised that point, I'll just cover that also. So when there are free samples, the buy one get one free, no 194R. But if it is completely free samples that is being given, it has to be charged to tax, subject to TDS under 194R. So even the address two situations. Doctors are working or attached to a hospital. They are given free samples by the who has to do a 94R. In that scenario, they are told that if they are attached to a particular hospital, even they are consulting doctors, hospital should do the TDS under 194R for the doctors, and this fellow has to do TDS on the hospital. So, as I told you, anything that they introduce it with a layer of complexity. So this is what you can see in this guideline which is given for deducting tax in the context of free samples.
And for suppose some tools and all, if you are achieving so many dealers can go on the foreign tool.
Applicable.
No, that is everything. How will the dealer show that? How much?
His question.
What portion?
So he had that.
No, but what portion of that will be there? For them it will be that whatever 5 lakhs something that they can deduct and go.
No, that is what. That is where the mitigate problem will come up in valuation. So I adopt a certain value, fair market value. At least in your example, there is a way to quantify that because I have the 2 tickets, boarding and
No,
lodging.
that is the total amount and they deduct.
You have the evidence.
There are 20 dealers who are participating.
So if it is 20, see the thing, one more very important thing, that's a good point here. In the context of dealers conference, there has been a clarification which has been given, which you could possibly apply it in your question. They say that if there is some common or general expenditure incurred in that particular conference, which was a group activity, wherein you cannot appropriate reasonably that expenditure to each dealer who has participated in the conference, then don't claim that expenditure itself in your books when you are doing the tax computation. Disallow that expenditure, then I will treat you as you are not an assessee in default. Otherwise, you 40A IAM is going to come, I will treat you as assessee in default. This is the clarification they are given.
So they can look it as business promotion expenditure.
Business promotion, they have always been doing it. Where is the TDS? If they don't do TDS, then gone.
But if they do TDS, they cannot give it to anybody. I mean, they can do TDS and claim.
Yeah, that is what. Now, what will happen is, somehow you quantify something, allocate it. Will that recipient agree with you? So, your question will come, how will I offer it to tax? So, a lot of practical issues under 194R. I may require 2.5 hours to do 194R. But this is just to give you some kind of a hang of what is 194R. With this, I would conclude my session. Thank you all for the participation. I would thank Bangalore branch for giving me this opportunity to discuss this. In fact, this opportunity gave me a motivation to learn TDS much more in depth and deliberate it with you. If not for this, I would not have been able to go through the provisions in so much of a detail also. Thank you once again. Thank you, Bangalore branch. Thank you, Kotak.
thank you for taking your time out and then coming and addressing our members and sharing your knowledge on TDS provisions. Hope you all had a good session with him. I request our chairman to hand over a moment to Vinay Sanji sir. The next session, post-lunch session will be on 234A, B, C and all the other related, 234D also. We'll break for lunch now and 2:30 the session will commence. See you all.
Good afternoon, madam.
Yeah. Very few voices. Just confirming that none of you are sleeping. Okay. So after TDS, it is the refund sections which we are talking about. I mean interest sections, interest on TDS and advance tax. So we have Arjun KR with us to share his knowledge on this. He will be taking us through 234A, B, C, D, E, F as well as 244A. I request Chairman Pramod to escort him to the dais and greet him with the floral bouquet. Welcome to you, Arjun. Brief introduction about Arjun. Arjun is a commerce graduate from St. Joseph College and he qualified as Chartered Accountant in 2023. And his journey began as a Chartered Accountant during his articleship period where he gained a valuable experience on various aspects of audit and assurance, consulting, direct taxation and encompasses business consulting. Basically he is an all-rounder, he knows everything around what is involved in the practice. Currently serves as a partner at the firm and holds a leadership position as the head of the business consulting vertical. His primary focus is to provide advisory and consulting services with a special emphasis on catering needs of startups and MSMEs, startups and SME clients. So this is a brief intro. It's a pleasure to introduce Arjun to you all, and Arjun, over to you. All the best. I would like to acknowledge the presence of our past president, K.R. Raghu sir. Welcome to you, sir.
Welcome, sir.
Yes, slider is there.
So good afternoon everyone. Thank you very much for the introduction, Kavita ma'am, and also to Mr. Pramod Hegde, the chairman of the Bangalore branch. And is this all we have, or are any more people expected to join? That's it. Oh. And online also we have people.
This will be uploaded into.
Okay, this will be uploaded. Fair enough. So today I've been entrusted with the task of taking you through the income tax provisions with respect to interest and refund. So the focus areas I would split it into two. One is 234A, B, C and D, and then I'll also be taking a quick snapshot of E, F, and then we'll again go into 244A, which is interest on refund. So before we dive into the concepts under these sections, I thought it's only right to just quickly discuss the income tax softwares which are used by the department for processing these interests and taxes. So previously we had AST, now we have ITBA. So the core functional difference between the two is that ITBA allows the income tax officers to process everything electronically. As we are all aware, everything is faceless now, and this is a product because of ITBA that it is possible. Now the process in which both these softwares work is fundamentally the same. The way they extract information from individual ledgers and process the interest and taxes. The main key difference is in the aspect of manual override. So previously under the AST module, what used to happen was that if at all a taxpayer approaches the assessing officer, they can also request for a modification in the interest under 234A-BC and also 244A. But now in the new ITBA, that has been completely eliminated, and it does not allow any human intervention whatsoever. So to have a quick introduction of 234 A, B, C and D. So what we need to understand is that there are different types of interest and that are levied for either a delay or a default. So 234A deals with delay in filing of ITR and nothing else. So it's purely in case when you are filing your income tax returns after the due date prescribed under 139(1). 234B talks about non-payment or short payment of advance taxes. 234C talks about non-payment or short payment of individual installments or installments of advance tax. And 234D is a case where excess refund has been granted to the assessee in case of regular assessments. Another important concept before we just dive into the sections is Rule 119A, which basically gives the entire basis for how interest is calculated under the Act. So if you see the first section, it says where interest is to be calculated on an annual basis, a part of the month shall be ignored and any fraction shall be ignored and the period would be rounded off to the next month. So if it is 0.5, you will not consider anything. If it is 1 and above, then we would be considering interest in case of annual basis. But when interest is to be calculated on a monthly basis, any fraction of the month also shall be deemed to be a full month. And in case of tax, penalty or any other sum in respect to which interest is calculated, the tax, such amount would be rounded off to the nearest multiple hundreds, right? So it's not tens, it's not thousands. What we need to focus, it's rounded off to the nearest hundreds. Moving on, another important concept for us to understand is what is assessed tax. And to quickly summarize what assessed tax is, it is the total income that is shown under section determined under 143(1), and it is typically before any interest or penalty is levied. And how we calculate assessed tax is we take the total income and then we deduct the TDS, TCS, the relief allowed under section 89 to 91, and tax credit allowed under 115JAA and 115JD. And as you're all aware, 115JAA is on AMT, that is alternate minimum tax, which is applicable to non-corporate assessees, and 115JD is on the tax credit that arises in case of mergers or amalgamations. 89 is in case of arrears of taxes. 90 is in case of foreign tax credit when we are claiming foreign tax credit while filing the return. 90A is a case where there is a DTW agreement between two contracting states, and we're utilizing the effect of that. And 91 talks about cases where we don't have a DTW agreement and how it should be, how is the tax calculated in that aspect. So moving in to the first section which we spoke about, 234A, it is typically on the it is the interest that is levied only in case of delay in filing of your income tax returns. And the base for this is again section 143(1), which we kind of already discussed in assessed tax, where you take your total income and then you have your deductions, you have your assessed tax, and then once you file your return and it's processed, you get an intimation. So that is the entire process of how the return is filed. Section 234A, so what is the purpose of this? So in this case, it is mainly for delay in filing of ITRs, filing of an updated return, or filing of a return in response to a notice under 142(1), where assessment officer requests for additional information that he may perceive Then the rate of tax in this case would be 1% per month or part of the month, and the nature of interest is simple interest. So there is nowhere in these provisions that we'll go through today where there is compound interest involved. Every aspect is only calculated on simple interest. So what is the amount liable? Again, amount liable, like we discussed, it's the tax minus the advance tax, TDS, relief under 89 to 91, and tax credit claimed under 115JAA and JD. Now, one important explanation that is there to 234A is that if at all there is any income tax, additional income tax that is paid under 140A, which 140A talks about self-assessment of taxes. So, sorry, this is 140B. So 140B is when we are paying when we have not filed a return in due time, but we have complied with all the procedures before the filing of the ITR. So in that case, this has to be excluded. Section 140B, if any interest paid under 140B will be excluded. Now subsection 2 of 234A talks about interest that is paid under section 140A, and which is self-assessment of taxes. So such amount would be deducted from the interest that is calculated under 234A and then will be assessed. 234A subsection 3 talks about a case where you file a ITR, but income tax officer issues a notice under 148 or 153, and they ask you to furnish your return again. So what happens in this case? They give you a due date generally in the notice, and interest is calculated in two ways here. One is, if at all the interest, if the return is furnished after the due date that is mentioned in the notice, it's 1% per month or part of the month until the date of filing of your return. But where no return is furnished at all, say if the assessee is ready to take the risk and not do anything about it, in that case it is only up to the date of completion of the assessment or reassessment. So date of expiry of the notice to date of completion of the assessment. Then moving to subsection 4, where we talk about an order that is received under 154 or 155, that is a rectification order. What happens here is that, or under any of these sections that we can see, 250, 254, 260, if the order states that the tax has been increased in the order, so correspondingly the interest on the tax also would increase, and if at all is decreased, the corresponding interest under 234A also will be decreased. So in case it increases, the assessing officer is actually supposed to send the assessee a notice under section 156 to say that, okay, listen, this is what the tax is payable and please pay it. And where in case the interest is reduced, this shall be refunded to the assessee. So this is a very, very quick and very easy illustration that I've put out here. So here we are saying that Mr. Kumar runs a medical store. Due date to file his income tax return is 31st July. However, he filed it on 3rd of December. And his tax liability is 28,400, and advance tax was paid for rupees 15,000, and he has a TDS credit of 5,000. So will he be liable to pay interest under 234A? If yes, then how much? So what we can see here is very clearly that he has exceeded the due date under section 139 to file his income tax return, and the number of months he's exceeded by is 5 months. So it's actually 4 months and 3 days, but like we said when we read in rule 119A, anything that is part of month shall be rounded off to the next month. So when we're saying 4 months and 3 days, it would essentially mean 5 months. And the interest would come up to 420 rupees. Now, I've added some more components in this illustration, where we say total income is 12 lakhs, tax is calculated at applicable rates, then there's advance tax, TDS, TCS, then there's relief under 89 to 91, then there's tax credit under 115JAA and JD, and there's additional income tax under 140B. And 140B, if you recollect, was one of the explanations that we just went through in 234A subsection 1. So if we look at the answer to that, so we take the tax, we deduct the advance tax, TDS, TCS, we also deduct the reliefs and the tax credit on 115 JAA and JD, and there will be a net tax liability that would come out in this manner, and we would calculate the interest under 234A for a period of 2 months, because his due date was 31st July and he's filed it in September, as we all see. So 2 months would be the interest applicable in this case. And we'll also not be calculating, we'll not be including 140B anywhere in our computation because of what we read here. So if we see note 1 there, we say total income determined under 143 shall not include any additional income tax payable under 140B. So hence we are not including this in our illustration, though there was additional income tax paid by the assessee. Now here this is an extension of the previous illustration. The addition here would be that there is interest paid under section 140A, which is our self-assessment tax, and there was a notice under 148 issued on 1st of November where the assessing officer reassessed the income to 1,50,000, and the time allowed was 30 days to file it, and he filed it 1 month later than what was asked to be filed. So 31st December is when was the actual filing. So if we see until step 1 to step 5, it's the same way how we calculated in the previous illustration, and then the delay would be again 2 months for filing of the return. And here we will be reducing the interest paid under section 148, that is when the assessee pays his self-assessment tax and he pays any interest at that time, this will be reduced at this point in time. And hence we see that 1000 is deducted from 2180 and we have 1180 as the net interest payable under 234A. But an additional point here is the fact that the assessing officer had reassessed the income to 1,50,000 like we see in the question here, and what our net tax liability is 1,09,000. So there is a reassessment of upward reassessment for rupees 41,000, and for this additional reassessment in tax, there will be a interest that will have to be paid for 1 month because of the fact that he has not filed it within the due date. So the due date in this, if we see, is 30th November. So if he had filed his return before 30th November, then we would not be seeing this last point on additional interest. But because of the fact he's exceeded whatever the time limit is given under the notice, we are paying 1 month. So due date was 30th, we have paid on 31st. So we are saying there will be a 1 month of interest that would be applicable. Now moving on to some interesting case laws that I picked out, which would be relevant for all of us. So first one would be Prannoy Roy versus CIT, and in this case what had happened is that the assessee had substantial capital gains income for the year 95-96, and what happened was very strange, where he actually forgot to file his income tax return for the year, but he had actually paid all his taxes well within time. So if you see the facts of the case, we can see that there was capital gains for assessment year 95-96. Then the income tax return was due on 31st October, but it was of 95, but filed only on 29th September 96. And the taxes due were paid on 25th September 95, and the returned income was accepted on 29th January 98. So what the issue here is that whether 234A is applicable or not, because of the fact he has actually paid his taxes but not filed his income tax return. And if you purely think from the assessing officer's standpoint, he is not totally wrong, right? Because 234A clearly says that it is interest levied in case of delay in filing of your ITR. So if you look at that aspect, you would feel that the assessing officer is right in his way. But what actually came out was very interesting, so the assessee filed a revision petition but again was dismissed. then the assessee filed a writ petition in the High Court, and the High Court actually set aside the interest that was levied by the assessing officer. And the reason why the and then the revenue upheld the decision of the High Court again when the revenue went for an appeal to the Supreme Court, but our Supreme Court retained the decision of the High Court. So now why they retained the decision of the High Court? They use these words where they say interest under 234A is not a penalty but a compensation for delay in tax payment. So they use this as the basis and pass the case in the favor of the assessee, where they say that he has actually paid his taxes in time but forgot to file his income tax return. And they also have given a link to another case law of Pranay Roy itself. So they establishes that interest is compensatory in nature and not penal in nature. So I think this is the crux of this entire case law, where under 234A interest is compensatory and not penal in nature. Then moving on to the next one, which is Apollo Pharmacies Limited versus the DCIT. So the company initially declared a total income of 104 crores and received a demand notice of 5.78 crores and was issued an interest payable under all the three sections of 234A, B and C. Now what are the developments in the case? So as soon as the return was processed under 143(1) by CPC, the case underwent a scrutiny under 143(3). And the demand notice raised was again 6.25 crores against what was initially raised was 5.78 crores. So leading the assessee to appeal to the order before the CIT appeals. And then what happened was the assessee was aggrieved and hence went into writing a petition to the CBDT chairman, and where they submitted a petition under section 1192B and 1192C. So 1192B talks about cases where the assessee has a refund or he has carry forward of losses and was not able to file his return due to anything that is out of his control, and purely this is on a case-to-case basis that is decided by the CBDT chairman whether they should process and accept a waiver or not. And 1192C talks about cases where the assessee has chapter 6A deductions and however was not able to comply with the provisions of the act due to things that are outside of his control, and again it is in the discretion of the officer to whether they would like to waive off the interest or not. But what happened in this case, so the petitioner actually requested CIT appeals to hold the appeal proceedings because of the fact that they had written a writ petition to the to the CBDT chairman, but the CIT appeals didn't wait actually. So they went in and they processed the demand and issued the notice to the assessee. But however, the tribunal found fault with the approach of CIT appeals, and they directed them to wait for the outcome that the petitioner's appeal with CBDT was lying. So wherever we come across a case where a writ petition is filed, but say the CIT appeals without waiting has gone ahead and processed the order and claiming for a demand, we can actually say, you know what, we have to wait because the order by CBDT is not yet processed, and you taking a call before that would not be extremely right, and we can definitely quote one of this case law on Apollo Pharmacies. Then moving on to the third one, which is Indu Rohit Kumar Pathak versus ITAT. So what happened in this case is very interesting. So the assessee was never really filing her income tax return, and what happened was that year they purchased a property, right? And they earned some income out of it, and which was picked up by the ITBA. Right? ITBA picked up this fact, though the assessee had not disclosed it, and the AO assessed the total income to 35.53 lakhs. And So what happened in this case was there was an income escaping assessment that was initiated against them. And what the assessee's argument, if we see there, is that there was an interest of 4.5 lakhs that was charged under 234A, which the assessee claims is unlawful, as the return was filed under 148 and not 139. So why he's actually saying that, why the assessee is actually saying this, is because she missed all of the deadlines as per 139. And she's filing her return only by virtue of the notice that was received under 148. So interest should not be charged for the period when it was not possible to file the return, was the argument. But department stand is also quite valid. If we see, they say interest is mandatory under 234A for all returns filed late. So, and also there was a taxable income in this case, but the assessee had not disclosed it. So if you think about the department stand, it's not too wrong. They are fair in their own judgment. But what CIT appeals had to say is that interest should be charged only from the date of notice under 148. So when we went through the, I'll just take you quickly back to that subsection. So here, the third subsection, we said that if there's a notice under 148 that has been issued, which was the case that we're discussing now, and where the return is not furnished at all. So it would be from, the period should be calculated from date of expiry of the notice until the date of completion. So clearly taking this subsection 3 of 234A, the tribunal, if I'm not wrong, let me just go back. Yeah, the CIT appeals stood on the ground and said that there would be interest that is levied only post the expiry of the notice under 148. Then there's another interesting case which is on Computer Modeling Group versus ACIT. So what happened here is that the assessee is actually is a resident of Canada and provides a software simulation service to all the oil companies based in India, which is essentially like ONGC and Vedanta. And what the assessing officer did, interestingly, taxed the entire receipts of the assessee under section 44BB, which talks about income that is generated by non-residents in the industry of oil and gas explorations. And the Commissioner of Income Tax actually upheld the AO's decision when the assessee appealed. But however, assessee didn't stop there, went further to appeal to the tribunal, arguing that it did not have a PE in India, a permanent establishment, and hence its income was not taxable under section 44BB. So the key legal provisions for us to probably just run through is section 44BB, which deals with, again, we spoke about taxation of non-residents who are earning income in India in the area of oil and gas exploration. And there's a double taxation avoidance agreement between India and Canada, where the assessee claimed the beneficial provisions of the DTAA. Now what really happened after that? Okay, so what happened here is that in the end, the assessing officer was supposed to review his entire case, and the assessee was not required to pay any tax here because they did not have a PE in India. So the presence of PE is very important, is the crux of this entire case law for us. Then moving on, another case, I think this was 234. Yeah. So Malay Car versus Union of India. So what happened in this case is that the assessee was actually called upon to pay additional income tax because his employer actually did not, the company where he was employed, did not deduct taxes, and so they deducted taxes but did not remit it to the government. And what happened in this case was they requested the assessee to come forward and pay the additional income tax. So what were the rulings here was that there was a bar on the direct demand under section 205, where it clearly states, section 205 states that the assessee shall not be called upon for whatsoever reason to pay additional income tax if his income that he's received has already been subject to TDS and he has received the deducted amount into his bank account, and it would not be right to ask the assessee to again pay in such cases. There is also a CBDT circular dated 1st June 2015 in this regard, which supports the non-enforcement of demands where TDS has not been deposited by the deductor. So in this case, the employer actually had not deposited the taxes to the government, and hence they asked the employee to come and pay, but by virtue of this, the employer was actually forgiven and did not need to pay the taxes. So what happened after that, there was a writ petition that was allowed, and the income tax department must give a credit for the TDS amount and refund any recovery that was made from the assessee. So I think this got interchanged, but I think we went through the computer modeling group. So what we discussed was that in the absence of P, it would not be taxable. So I think this got interchanged. Then when we're talking about the next case law, which is Lalit Johri versus ACIT, the assessment year was 2014-15. The original due date for filing the ITR was 30th September for that year. And there was a search that was conducted on 8th of May 2014. There was a notice under 153A issued requiring the assessee to file the returns for assessment year 9-10 to 14-15 within 30 days. So the assessee actually filed the return for assessment year 14-15 on 12th of March 2015. That is within the notice period that was given by the assessing officer. And the assessment under 153A was finalized, read with 143 was finalized. And the assessing officer noted that actually there was a undercharge of 234A, interest under 234A, and then issued a rectification order again under 154 and levied interest for the period from 39, that is the due date of filing the return, to the actual date of filing the return. So what happened here, Commissioner of Appeals, the CIT, confirmed and did not do anything about the assessee's appeal. However, when it reached the tribunal, this was overturned, and the Commissioner of Appeals' decision was overturned and was passed in favor of the assessee. So what the tribunal's analysis was in this case is that once the search is conducted, 153A, under 153A, it would override all other provisions including section 139. And the assessee is required to file the return within the due dates prescribed under the section of 153A. And in this case, the assessee also filed the returns within the due date as we see, and hence there was no interest that was levied, and the assessee was forgiven for the interest. Now this brings us to the end of 234A. If we have any queries on this, we can probably discuss now, or we can move on and then take it up at the end. So however you would like to proceed, we can do that. Proceed? Okay. So before we get into 234B, again let's just discuss quickly a couple of important things. One is on advance tax and its applicability. So to whom all is advance tax actually applicable? So if we see this slide here, we say individuals, whether they're salaried or professionals, you're liable to pay advance tax if your total tax liability after TDS is more than 10,000 in the financial year. Then businesses and corporations, it means any businesses, whether it's corporate or non-corporate, including partnerships and LLPs, and the same criteria applies to them as well. The 10,000 criteria is overall in all assessees, that would be the threshold limit. And in case of self-employed professionals, the reason why we have put this separately here is that many self-employed professionals would directly be dealing with customers who are not businesses. So it's a B2C, in other words. So in that case, the customer would essentially not do TDS for them because they would not be required to. And in that case, if their income tax liability is more than 10,000, they should pay advance tax as well. And the last point is where we have capital gain and other sources of income. And the reason why I have highlighted this point separately is that there are individuals that earn substantial amount of income under these two heads, and typically they should pay advance tax again in case the tax liability exceeds 10,000 rupees. Now moving on to section 234B, which talks about interest on default in payment of advance taxes. So the core purpose of 234B, what we are speaking about now, is it is levied only when there is non-payment of advance taxes or there is underpayment of advance tax. So in case of non-payment of advance tax, what it essentially means is that the advance tax is applicable, but the assessee fails to pay it. And underpayment, when we are talking about underpayment, it means that the advance tax is being paid by the assessee, but has paid less than 90% of the total assessed tax. And assessed tax we already discussed at the start, where how we calculate it. So it is based on assessed tax. Now the rate of interest would be at 1% per month or part of the month, and again it is simple interest. Like I told you, everywhere we would be talking only about simple interest. And how it is calculated. So an assessee who is liable to pay advance tax has failed to pay such tax. So interest is calculated on the assessed tax, and the period for which it is calculated would start from the 1st of April of the assessment year until the date of determination of income under 143(1). Or in case where there is an assessment, it would be until the date of such assessment is completed. Now the next case where the assessee has paid advance tax but not up to, it's less than 90% of the assessed taxes. So the amount which is liable to interest would be the assessed tax, which is deducted with the advance tax that is paid by the assessee. And the period again is from 1st April of the assessment year to the date of determination of total income under 143(1), or wherever there is an assessment until the date of assessment. So when we say 143(1) here, it typically, practically it would be when the assessee files the ITR and pays all the taxes. So subsection 2 of 234B talks about cases where tax has been paid under self-assessment by the assessee. So in such cases, whatever tax has been paid would be, if you see the table that I've put up there, it says that interest, if any, that is paid under 140A shall be deducted against the total at the end of the year. When you calculate your 234A interest, your interest on self-assessment tax will be deducted from your 140A. Your total interest under 140A will be deducted from the 234A interest that you have arrived at the end of the year. Now post 140A, after you make the 140A interest payment, what happens is your interest will be calculated by your tax paid, you add your advance tax and deduct your assessed tax. So on this, then you pay your interest at 1%. Now another couple of clauses under this 2A subclause A and 2A subclause B. So 2A subclause A is an application under 245C1, which is an application made by the assessee for settlement of income taxes. And what happens in this case is typically there would be a search, for example, that has been conducted, and the assessee is willing, whatever say cash was found, the assessee is willing to give that up and also file a settlement with the income tax authorities. So in that case, the assessee will calculate his interest under 234B from 1st April of the assessment year until the date of application, and it would be again at 1% per month. And subclause B is nothing but an extension of subclause A, where the settlement commission will review the application that has been submitted by the SSE, and if at all there is any increase in whatever application is filed, they will order the SSE to pay the additional interest. So the period for this again would be from 1st April until the date of order. So if you see, typically if at all there is an increase in the interest that the settlement commission has requested for, it would be a difference between A and B. So the SSE is already paid interest until the date of application, and maybe after, if at all it's increased, he would be required to pay again interest until the date of the order. And again that would be at 1% per month. So subsection 3 talks about cases where there is a reassessment or recomputation order issued under 147 or 153A, and interest is payable in respect of shortfall in payment of advance tax. And again the interest period would be 1st April of assessment year to the date of reassessment under 147 or 153A. Interest would be again at 1% here, and the calculation remains the same. So the next one is subsection 4. Again this is the exact same subsection 4 of 234A, which is reproduced in 234B, which says that if there is an order under 154, 155, 250, 254, and because of this, if the tax increases, correspondingly the 234A interest also would increase or decrease as the case may be. So it is the exact same thing that has been reproduced from 234A. So I think that should be enough. I mean, I don't want to go much more into detail on this subsection. This is another very easy and simple illustration that I've put out here, where Anish is liable to pay a tax of 50,000. There was no TDS done. He had to pay, as he had to pay a tax of 50,000, which is more than 10,000. So he would ideally had to remit advance tax, but he has not done so. So what has happened in this case? He's filed his return on 15 June. At the time of payment itself, he has filed his ITR. So he is responsible for paying interest under 234B for 3 months, and April, May and June. And so the calculation would be 50,000 into 1% into 3 months. Then moving on to the case laws under this 234B, under section 234B. This is a recent one actually, which was passed in 2024. The finality of the order came out, where is Mariama Joseph versus ACIT. So the assessee's income for the assessment year 10-11 was assessed under 153A, right? And during the proceedings, interest under 234B was incorrectly calculated for 42 months instead of the correct figure of 36 months. And this miscalculation was rectified by an order under 154, right? Correcting the interest to 36 months. Now the assessee's argument was that her returned income was 10.84 lakh, was processed by March 2012, and she argued that interest under 234B should be calculated from the date of processing up to the date of reassessment under 153A, which is March 2012 to March 2013. And the amendment to 234B, which is effective from 1st of June, would not apply in her case. So what was the assessing officer's argument? So the assessing officer said that interest on the differential tax of rupees 15.37 lakhs should be calculated from 1st of April 2010 up to 31st March 2013, which is 36 months. What actually happened at the end? If you see the amendment, the first 2 points, I would not go into that. The interest charge was correctly calculated for 36 months from April 10th to March 2013. The appellate order dated 16th Feb 2016 adjusted the interest based on the reduced assessed tax, and the rectification order was correctly applied. And what happened at the end was assessing officer's calculation was deemed to be correct. So there was no relief that was provided to the assessee in this case, because it was calculated correctly, and though it was challenged, it was upheld by the income tax appeals.
It was calculated for 43 months.
40, it was initially calculated on 42, then they rectified it to 36. The next one is another interesting one, ZTE Corporation versus CIT, where the company was a resident of China and had a permanent establishment in India. So in the previous case where we saw about the permanent establishment, the assessee did not have a P in India. But in this case, the assessee has a P in India and is engaged in the business of selling telecom equipments. So what the AO did here, the issue typically arose where the AO attributed a percentage of the sales of the company as profits to the PE and levied interest under 234B for failure to pay advance tax. Now, what the High Court said is that since the assessee is a non-resident company, all of its income in India would be subject to TDS, and hence 234B would not be applicable. And they dismissed the order issued by AO, and there was no interest that was required to be paid, purely by the virtue of TDS being done by the Indian companies. Whoever were taking services from them would have ideally had to do TDS under 195 to non-residents, and hence 234B would not be applicable in this case. There's another interesting case law here where this is between Shiv Shipping Logistics versus Income Tax Settlement Commission. So there was a survey that was done under 133A, and there was cash that was found at the assessee's premises. Now the application was for settlement under 245C was filed by the assessee, and the application was also accepted by the commission, and a final order under 245D was passed, including interest under 234B on the entire additional income without considering the taxes that are already paid. So the crux here, what happened is that they had certain taxes to their credit, advance tax, TDS, but none of them were considered when the search was issued and the notice was given. They had considered there was no other tax credits that are available to them and had passed the interest, they had recognized the interest calculation on the gross amount. So the assessee argument, like I just mentioned, it should be levied only on the additional income tax that is payable after reducing the taxes that are already paid. Now, what was the court's analysis? It was similar to what the assessee expected, where they said that interest would be calculated only on additional taxes after providing a set-off for prepaid taxes. Now, they also said that this is because the assessee has already remitted money to the government lying with the treasury, so interest should not be charged again on already paid taxes. So it would amount to double levy of interest is what was the conclusion. So that brings us to the end of 234B, and if we have any questions on that, we can take it up, or if we can move ahead, we can move ahead. Let me know. Any questions, anyone on 234B? We'll move ahead. Okay. So coming to 234C, where in any financial year, an assessee that is referred to in subclause B, which we'll go into later, who is liable to pay advance tax under 208. 208 is essentially the section that gives the power to charge advance, to collect advance tax. So the summary here, if you see, is that on 15 June, they should pay 15% of their income taxes, and 15th September it should not be less than 45%, and 15th December it should not be less than 75%. But for the month of March, So if you see for all the first 3 quarters, the interest period would be for 3 months. But for the 4th quarter, this interest period would be only for 1 month. Okay. So moving on to subclause B, which we said any other SSC other than the SSC referred to in subclause B. So subclause B talks about cases where presumptive taxation is applicable under 44 AD in case of business, or 44 ADA in case of professionals. So in this case, what happens is the SSC is required to pay advance tax only one time, on 15th March, and he does not need to comply with the other 3 installments. He can pay everything that he has assessed by 15th of March, and the interest would be again at 1%. Now there are certain interesting provisos to 234C. First one being capital gains, the second being winning from lotteries. Third one was first time income under PGBP that the SSC previously did not have, so it was not able to estimate its income for that aspect of its business. Then dividend income, for obvious reasons you really don't know the shares that you hold which company would declare dividend. But for all these 3 to apply, and for the interest not to be calculated for the first 3 quarters, what is important is that the SSC should have paid the total tax by 31st of March. So that 31st March is applicable only to these 4 cases, purely because of the fact that it's difficult for the SSC to calculate or estimate income under these heads. So the SSC has to pay the whole amount by 31st of March of the financial year. So this is again a quick summary of the entire 234C, where we said the SSC should pay under 208, and advance tax, if it's less than 15%, then there would be 1% per month for a period of 3 months, and similarly in the 2nd quarter and 3rd quarter 45% and 75%. But the 4th quarter, if you see the period, it's only for 1 month. So that's why I mentioned only 1% per month, and there is no other, so we don't calculate for 3 months in case of March. Now there's a proviso even here where they say that for the first 2 quarters, if you are not paying 15%, but you have paid 12 or more, so between the 12 to 15 range, if you have paid your advance tax, there would not be interest would not be applicable. And in the 2nd quarter, it is 36% or more. So between 36 and 45 is the buffer that the government has given the SSC, where if it's between these ranges, then again interest would not be applicable.
Even in the 44 AD cases also, 44 AD, 1 month will not come for them. They're paying in March.
Yeah, they will pay only in March directly, nothing else for them.
C will not have.
Correct. So this proviso itself would not come because they would, no, the proviso, if they have these additional incomes under these heads, then it will still be applicable. Yes. So I've again put some quick illustrations for us to discuss. Mr. Ravi, a resident individual, has the following income: PGBP of 10 lakhs and capital gains of 2 lakhs, which he's realized in 1st of January 2024. And he has also paid advance tax installments, 4 installments respectively. The amounts are also given there. But he has also paid 20,000 separately again for his capital gains on 15th of March. So if you see the tax calculation for the PGBP plus capital gains, the PGBP income would be taxed at 1,12,500 and tax on capital gains would be at 10% without indexation. So the total tax liability is coming up to 132,500. So on 132,500, 15% would be required to be paid in quarter 1, that is by 15th June. So 16,875 would ideally have to be paid by the SSC, but actually the assessee paid only 13,500 and there was a shortfall of 3,375, but the proviso of 234C would kick in here because of the fact that it is between the 12 to 15% range and there would not be any interest that would be applicable in quarter 1. Quarter 2 also is a similar case. The assessee has paid in excess of 36% of the assessed tax. So 50,000 was what was required to be paid. He actually paid 45,000. So a shortfall of 5,000 falls within that range of between 36% and 45%. On 15th December, however, this would not apply. The proviso is applicable only for the first 2 quarters. So in the third quarter, if anything less than 75%, even if it is 74%, there would be interest applicable for 3 months. And that is what has been computed here as well. In the fourth quarter, that is 15th of March, we are saying that entire taxes were paid by the assessee and hence there is no interest coming to the last quarter. But also if we see the interest on capital gains is not included here. Because of the fact that he had paid everything by 31st of March, he did not have any interest that was applicable under 234C. Now there are also certain conditions for waiver of interest under 234A, B and C. First one being in case of a search and seizure where the assessee is unable to file the income tax returns due to circumstances beyond their control that is encountered during the search proceedings. Then where there is cash that is seized at the time of during search operations, and such cash that is seized, ideally the assessee will request the officer to use this to set off their tax liabilities. But in case that is not been allowed, it would obviously cause difficulty for the assessee to pay the advance tax. Then there's unanticipated income, again like other than capital gains, which is received after the advance tax installments. But however the tax is paid subsequently in subsequent installments, then there are probabilities that you might get a waiver. Then if there's a retrospective amendment or a Supreme Court decision, and that would happen appropriately, and any unavoidable circumstances where the assessee has voluntarily, in case where the income tax return is filed voluntarily by the assessee or the legal heirs without the detection by the assessing officer. So I think that brings us to the end of 234C, and if we don't have any queries, we will move ahead to 234D. So 234D, when we are talking about 234D, subsection 1 talks about where a refund is granted to the assessee under 143(1), and actually there should not have been any refund due to it, right? Or that the amount that has been refunded is in excess of what that should have been refunded in the first place. So if we see the interest amount on which interest is payable, in the first case it would be payable on the entire amount because there is actually no refund liable to be paid to the assessee, but was paid. Hence the interest would be calculated from the date of grant of interest, date of grant of refund, to the date of assessment or to the date under 143(1). And in case of excess amount refunded over the amount that is actually to be refunded. So the first case where the entire amount had to be refunded back, but in the second case where there is a differential amount where they have refunded excess more than what they should have, the second case would be applicable and the period again remains the same, and the rate of interest in this case would be 0.5% from June 1st, 2003, and it's 0.5% per month. I think that got missed. So under subsection 2, we say that if there is an order under any of these sections 154, 155, 250, 254, 260, 263 or 264, or a settlement commission order under 245D, the amount of refund that is granted under 143 would ideally have to be reduced accordingly as per the orders. So if there's any order that has been given and as per the order there's a lesser interest that is liable to be received by the assessee, that would be adjusted appropriately. Now again, explanation 2, I think I already mentioned that this would be applicable from the assessment year commencing. So it says that for the removal of doubts, it is hereby clarified that the provisions of the sections shall also apply to an assessment year commencing before 1st of June 2003 if the proceedings in respect of such assessment year is completed after the said date. So what this explanation is saying is that if an assessment has been started for an assessment year before 2003 but has ended after the introduction of this, that is after 1st of June 2003, then this section would be applicable. So taking up an illustration under 234D, where we're saying that Mr. X, a non-resident, files income tax returns for on 30th September, and X declared in his return 4.55 lakhs and an advance tax of 47,000, and the assessing officer refunds under section 143 excess tax paid by the assessee on 20th of July 2023. So if we see tax on 4,55,000 was calculated to be 10,250, then we add the cess, then we add interest under other sections which they mentioned under 234C, then we get the total tax that is payable. Then on that we reduce the TDS of 42,533, and then we get the refund that is to be paid, which is 28,373. Now this and then interest would be calculated on this at 0.5% for 4 months, if I am not mistaken. So if you see below the table, we say the assessing officer issued a notice under 143.2 on August 16th, where the assessment is completed on March 26th, and the income assessed is either 4,80,000 or 7,85,000. I'll take you through the next slide, and it says that the interest under these two cases would be 3,650 or 6,550. So we have calculated we have solved this in two ways here. One, we have shown if the assessed income is 4.8 lakhs or if the assessed income is 7.85 lakhs. Now in the first case, 4.85 lakhs, there is income tax on assessed income. Then you add your tax and surcharge, health and education cess. We add the interest under 234C that they mentioned. Then we deduct the TDS. So the refund that is due is 26,950. Then we add the interest under 244A, which was paid, which was 2,152, and the refund was rounded off to 29,090 rupees. But the amount that was actually refunded was 30,650. If 30,640, as per this slide, if we see, this was the amount that was actually refunded to the assessee. But on reassessment of income to 4.8 lakhs, the assessee should have ideally received only 29,040 rupees. So there was an excess refund that was given of 1,150 rupees, and this interest should be payable by the assessee for the excess refund that he has received from July 20th to March 26th. So July 20th, if we see, that was the date when he actually got the refund. So if you see the third line here, assessing officer refunds the excess tax paid on July 20th until the date of completion. So the date of completion was March 26th. So we are talking about a 9-month period here where interest is calculated under the first case. Under the second case, where income is assessed at 7.85 lakhs, we have our income taxes, cess, health and education cess, we have our tax payable, and also we have calculated the interest. and deducted the TDS. So here if you see, actually there's a tax payable and there is nothing that the assessee has to actually receive. So in this case the assessee has to actually pay back 36,297 to the income tax department. But however, he had received a refund of 30,650. So on the entire amount of refund, he has to pay interest for a period of 9 months. So like we discussed in the start, 234D has two parts. One is if he was not supposed to receive any refund and has received it, which is the second case here. And in the first case we are talking about where there was excess that was paid by the income tax department. Now moving on to a few case laws under this section. The first one is from Reliance Energy Limited versus CIT, and the key issues that are highlighted here is that whether provisions of section 234D are retrospective and applicable to assessments completed before 1st of June. So the legal context, again we would be referring to 234D and explanation 2 which we reviewed at the start, which says that this would apply to assessments completed after June 1st, irrespective of the fact that it's an assessment of the previous year that is being done. Now the facts of the case is that this was pertaining to an assessment year of 98-99. The assessment was completed before 1st of June and not after 1st of June. So if we see, typically going just by this reading the explanation, whatever the assessee is saying is not right. So it will not be retrospective in nature. And since the assessment was completed before the insertion of this clause before 1st of June, this would not be possible and it would be a prospective application and not a retrospective application. So if you see the arguments here, what revenue said is that the issue at hand is on the retrospective applicability of 234D, and they say that there was a High Court judgment on Delta Airlines making that irrelevant. So they were trying to question what was already passed before, but the assessee's argument still was on explanation 2, which was that because the assessment was completed before 1st of June, they should not be applicable for the assessee. So if you see the judgment as well, the Supreme Court said that these provisions are not retrospective for assessments completed before 1st of June, and the High Court dismissed the revenues appeal, and the reliance on the previous case laws which was placed was continued to remain the same. So I think that brings us to the end of 234D, and if we have any queries there, we can maybe take that up, or we can move on to the second part of the focus areas, which is under 234E, F and 244A. So moving ahead, 234E talks about where there is income tax TDS returns, where the assessee has failed to file these returns within the prescribed time limits. A sum of 200 rupees would be levied for every day that the failure continues. So, I mean, we're all aware that for first quarter, the TDS returns have to be filed, then the second quarter. So, it's all based on the date of filing of return and not the date of payment. So, 234E deals with only delay in filing of the return. And whatever the subsection 2 here, I think is very important for all of us to keep in mind, that the amount of fee cannot exceed any tax that is lying to the credit of the assessee. So if there is a TDS of 10,000, but the interest, the fee under 234 is 12,000, it would be restricted to whatever TDS is there to the credit of the assessee. So this fee, in case there is a delay in filing of the returns, has to be paid first, and only then will the assessee be allowed to file the TDS returns. And without that, the assessee would not be able to file the returns in case 234E is applicable. Now, section 200A talks about processing of TDS statements, which typically I want you to draw your attention to point number C, which says that the fee, if any, under 234E is applicable from 1st of June 2015. So anything before that, the SSC can actually take a stand saying that, listen, this was not there, and they can actually avoid paying interest before 1st of June 2015. And the process, I don't think I would want to go into the entire process of how the intimation would be generated. I just wanted to draw your attention to the third point. So here another quick illustration where we're saying that in quarter 2, Form 26Q, which is payments for other than salaries, due date is 31st October, but actual filing happened on 20th of November. There was a TDS of 10,000 rupees to the credit. Quarter 3 was Form 27Q, then due date was 31st Jan, actual date was 15th of Feb, and the TDS amount on that was 9,000. And in quarter 4, which is Form 27EQ, which is TCS applicability on sales, and the due date was 31st of May, actual date was 15th of June, and the TCS amount was 20,000. So if you look at the solution here, for quarter 2, there's a delay of 20 days, and quarter 2, I think something.
20 days delay.
Yeah, I think this, we'll probably ignore that. Quarter 3, let's take up quarter 3. There's a 15-day delay there. 15 into 200 would be 3,000, and the maximum fee was 9,000. So since the total fee is less than the TDS amount, it would the 234E fees will prevail. So what I wanted to get out in quarter 2 actually is that in case the fee under 234E is exceeding TDS, whatever is lying to the credit. So I've taken an example of 60 days. So if you see that 12,000 and the maximum fee is actually 10,000. So in that case, it would be restricted to 10,000, and any extra 234E fees under 234E would not be taken into consideration. Looking at quarter 4, we are talking about the same. So 234E also has 12,000, and the TCS amount also we are saying that it is 12,000, and so the total fee would be again 12,000 since both are equal. Now moving into some more case laws. This is Station Headquarters Army versus ACIT, where the assessee was responsible for deducting TDS on various payments like salary and interest, and was mandated to file the TDS quarterly returns from assessment year 13-14 to 15-16. So what was the compliance? Well, the tax was deducted and remitted timely. The filing of the TDS returns was delayed. In this case, they did not adhere to the timelines, and the action of the AO was that they issued intimations under 200A and they levied interest under 234E. So when we read that, the third point I asked you to focus on was 234E interest, which was applicable from 1st of June. So the assessees, so the CIT appeal, when the appeal was filed before the commissioner, CIT appeals dismissed the case, upholding the AO's decision. However, the assessee's appeal contended that the insertion of clause C was effective from 1st of June, which meant that the AO could levy late fee only from 1st June onwards. So the legal provisions would be again section 200A, which we saw, which is essentially talks about the insertion of clause C, and section 234E, which imposes the fees for delay in furnishing of the TDS returns. So what was the tribunal's analysis at the end? on the examining clause C of 200A, they took a stand that it's implemented on 1st of June. So AO should compute and levy fees under 234E only from such date onwards. So it would be a prospective application and not a retrospective application again. So I think this is again analysis of legal intent, review of similar cases, and outcome of the appeal. If we just quickly run through that. So pre 1st June 2015, the AO cannot levy any fees under 234E, and post 1st June, AO is authorized to levy fee under 234E. Moving on to 234F, which talks about fees in case of delay in furnishing of the return of income. So 234F talks about where the assessee is required to furnish a return of income but fails to do so as per the due dates prescribed under 139(1). So there would be a sum of 5,000 rupees that would be levied in case of delay in filing of your ITRs. And if at all your income does not exceed 5 lakh rupees, this amount reduces to 1,000 from 5,000. So the crux of 234F is that if at all your income exceeds 5 lakhs, it would be 5,000, and if it is less than 5 lakh, it would be restricted to 1,000. And this is applicable from the assessment year commencing 1st April 2018. So a case law on 234F, which I thought was I should discuss.
234F, no? Is it increased now to 10,000? 234F.
I think they decreased.
Increased. Earlier it was 5.
Okay.
Now it is increased.
Okay, let me just
That
check
will come in
that.
143 one intimation.
143.
Intimation only the system calculates now.
Okay, I'll just
That's
check
another
that.
way.
I'll just check that. So this was Neera Mathai Asgan versus Union of India, where the petitioner challenged the constitutional validity of 234F, arguing that this section is penalty disguised as a fee and violates Article 14 of Constitution of India. So if we see the e-filing date was 1st July 2024, total income below 5 lakh and total income again. So if it's before, so I think this is the updated one. If I've taken it, I think this should be the right one. But anyway, we'll check that and come back.
I don't remember it is reduced. 10,000 only. Now increased.
Anyway, we'll get back on that. So the arguments that were placed by the petitioner here was that 234F is acting as a penalty rather than a fee, and there is no service that is actually being provided for this late fee, was the argument of the petitioner, and they're saying that it's violating the quid pro quo rule, and hence they're invoking Article 14 of Constitution of India. So the arguments by the respondents was that it is imposed for efficient tax administration, and they are indeed providing a privilege for late filing of income tax returns, and it is also a regulatory mechanism to ensure timely filing of returns. So taking the base of these three arguments by the respondent, this case was passed in favor of the revenue and not in favor of the assessee. Now there was a small point that I wanted to draw everyone towards to, is an interlink between sections 234 and foreign tax credit. So only a resident assessee can claim credit on tax paid in a foreign country or a specified country outside India, and foreign tax credit would be allowed only in the year when income is levied to tax in the resident country. So it has to be taxed in the same year in the resident country, and it cannot be taxed in the following year or in the previous year. So the interlink here is that the foreign tax credit, whatever is liable to the credit of the assessee, is not allowed to be utilized against interest, fee or penalty. Whatever it is, it has to be adjusted only against tax amounts. So if there is a DTAA between the countries in question, only the taxes covered under DTAA would be eligible for foreign tax credit. So a quick illustration here, again we are saying a resident taxpayer has earned foreign income and paid taxes in foreign country. So his foreign income is 10 lakhs, he has paid foreign tax of 2 lakhs equivalent to 20% of its foreign income. Indian tax rate is assumed to be 31.2%. Due date for filing of the return is 31st of July. Actual date is 30th September. Advance tax paid was on 15 June of 1 lakh rupees and date of assessment was 31st of March. So if we quickly look at this, the tax liability on the foreign income as per Indian taxes. So that's the first comparison for us. So we take 10 lakhs and multiply it with the Indian tax rate, which is 3,12,000, and the foreign tax credit, like we saw, was 2 lakhs that was paid. So the lower of the two is what would be allowed to the assessee as a credit and as a relief. And if you see, the calculation of interest would be again on the lower of the two. After taking the lower of the two, we deduct it from the total tax liability and we get 1,12,000, and interest under 234A would be for 2 months because he's delayed for 2 months, and 234B we are essentially looking at 90% of 1,12,000 because that is the crux for us to look whether the tax has been paid appropriately. So anything less than 90% is what we have to evaluate. So then we calculate that, we get 96, and interest under 234C is 1,800,000 minus 16,800, which is into 1% for 3 months, which is 2,496. Okay, so I think now we'll break for tea and then we'll continue the balance part. So the plan now is, I think, maybe another 15-20 minutes on the balance provisions, and then I have a small quiz where all of us will be participating together, and we will be answering this through our mobiles. So we'll be displaying the questions. You'll have to scan your QR code, and then everyone will be live on that quiz, and then that would maybe take about 20-25 minutes or 30 minutes, and then we would break for the day. So maybe how much time for break? 15. That we'll catch up after tea again.